All right, guys. Market is flying up today. Ooh. What's up, Kieran, Kevin, DS, Chris, Obsessed? Look at AMC. What's up, IJ? Hit. What's up, Twin? Yeah, most of the time I show my trades. All right, AMC. One of the big stories today. I am holding this. I told you guys I was holding this a couple days ago. Or a bunch of times, really. So we are in it. Good for AMC. Let's see if it continues. Look at the SPY, though, man. The SPY is ripping up today. We'll get some music playing as well, but are there any other like sympathy moves with AMC? GameStop up to 2340s. So Amazon is green after potential news of a Amazon buyout is what AMC is up. So yeah, AMC. All right, guys. So yeah, you see AMC popping up. You see the SPY at 399. Let's see if we can break 400 today. It's certainly possible that we do. Uh, but yeah, if you look at the AMC news here from yesterday, AMC is up after a lot of people are talking about a potential AMC. Amazon showed possible interest. All right, so AMC ripped up yesterday after the Intersect reported that Amazon Incorporated is weighing an acquisition of the movie theater chain and meme stock. They cited multiple sources close to this discussion. The Intersect reported that Amazon is exploring that AMC potential acquisition, but there's not really any certainty that the retail, company Amazon is going to make an offer. Uh, I hope they do. We'll see if they do. Let me know if you guys think they will. It obviously is making AMC rip. But yeah, AMC flew up here. You can see it's up to 520s. Yeah, I'm trying to figure out why the market is up. Honestly, I don't see much of a reason. Uh, could it be from the banking stuff that happened yesterday? We'll probably. It could be bank. There's the SPY at 399s. I'm looking to see if I can find any news on the All right, MU had good numbers. Yeah, so AMC is up. Machine buy, maybe. PC drops tomorrow. Let me see if I can move this. Yeah, it might be a little bit better. All right, we'll get the music playing. I was listening to Rage Against the Machine. Oh, my bad here. Hold on, there we go. All right. Honestly, I try to sleep in, but I never can. I was gonna start the stream a little bit later today, but then I saw the market ripping up and AMC moving up. I wake up at like 5 o'clock in the morning Texas time, regardless. So I can't sleep in if I want to be honest. But what's up, Pawn? What's up, Beach? What's up, Import? Vom, Dan. Mic is off today. Let me check it. Test 1 2 1 2. It should be okay. The right mic is plugged in. But yeah, I was thinking about starting later, but then I was just kind of like, well, I'm up, you know. What's up, Mimi? All right, guys. So yeah, honestly, AMC ripping up at 530s right now. SPY all the way at 399s here. Big rebound. I mean, we're gonna try to stream the bar testimony. I'm sure we're gonna have some people that want us to stream the bar banking testimony. I didn't realize that was going on yesterday. I probably should have streamed that. We're gonna try to stream it today. Starts at 10 o'clock. We also have pending home sales today at 10 as well that we're gonna be covering also. So we're gonna try to stream all that stuff. So we can cut. You know, I think that's going to be very relevant to market activity, and it'll move markets at least some. You know. I wonder where the guy from yesterday spamming crash went. I think he might have crashed himself. Honestly, people wonder why I'm biased against short crash predictions. Like I'm not like people get so weird, man. Like they get mad at me for being right, you know, which shows just deep insecurity about whatever direction they're pushing for. Like, who's the one that's been telling you guys we don't have to crash every day when they come here? I've been saying, hey, look, you know, that's sensationalizing the market. It's not healthy. Overall, we don't have to crash. We don't need to crash. It's not in a situation where a crash is absolutely imminent. And maybe we crash. I don't know. But it's certainly not something that has to happen. And Yeah, we're not crashing right now. We're all the way back up to 400. Market's been pretty strong over the last couple days. If you look at like a 10-day chart, we are now very green over the last 10 days. Started off at 390, back up to almost 400s. Right, that's basically how I feel. Counterparty, not you, but yeah, car dealerships can be sleazy, brother. Just be careful financing a car, man. It really is. It really is one of those things that can weigh on you for years, man. All right, guys. AMC at 530s. Look at the SPY at 399s here. I'm gonna do a poll about AMC today. AMC at 530s. Look at this. And the poll is gonna be: does Amazon buy out? Does Amazon acquire AMC? Eventually. Yes or no? Vote on that poll. Yeah, man. Yeah, I mean, listen, man. Okay, Ice. Let me help you out a little bit, brother. Hey, my guy, thank you, Jose. He said, morning AMC news of Amazon taking over, not confirmed. I'm watching from the stands. Thanks for the show. Hey, thank you, brother. I appreciate you, man. I really do. Thank you, man. But yeah, let me correct you regarding the yield thing. Somebody said, have we crashed every time the yield curve have been inverted? No, we haven't, bro. Just to put this into perspective, the yield curve happened July 2022, August 2019, and April of 2022. Okay, no crashes right afterwards, and so you're not really saying it right. Is the point here? And I hope you don't get mad at me for correcting you here. You're not really saying it right. What you're trying to say is that the yield curves being inverted preceded every recession we ever had. Okay, but the yield curves inverting does not. A recession doesn't happen every time that happens. Okay, so it's not something where every time the yield curves invert, we have a recession. It's just not true. Again, it happened in 2019, 2022. And so could we go into a recession? Sure. Is it a for sure thing? No. You know what I mean? Like, that's the whole point I'm trying to make. I'm not saying we're not going to do it. If you watch the stream, if anybody watches the stream, I'm not saying we're not going to crash. What I'm saying is that every day people have come in here and said a crash was imminent over the last 6 months. And that's just not happening, yet. And maybe it does. But even if it does, they've been wrong, And I don't think saying it every day is necessarily good for sentiment, Hey, we're gonna do a poll for tomorrow. There's economic data tomorrow. I'm one soul. We have PCE Friday. We have GDP tomorrow. So we have GDP data. We also have GDP data as well as jobless claims tomorrow. And even if we do go into a recession, which is more likely than a crash for sure. Even if we do, we still generally, like in 2007, for instance, right? The yield curve inverted in 2006. It was 235 days until we hit the recession afterwards. So it was a little bit under a year. It was about 2/3 of a year before we actually hit the recession. And so there is a lag behind it. So I guess the question is, when was the yield curve inverted? Goldman Sachs posted an article, why this yield curve may not signal a U.S. recession. And so maybe we do get a recession. I don't know. But they said the yield curve is the difference between yields of longer term. Okay, they're explaining what it is. Typically, long-term yields are higher because investors demand higher rates to compensate for future uncertainty. But it's been the opposite since the middle of last year in 2022. Traditionally, there's been a sign that investors anticipated an economic downturn that will dampen inflation. Inversion became more pronounced last week. So this was like mid-February when the 10-year fell to more than 0.85% points below the 2-year, marking the widest spread in more than 4 decades. And that yield curve seems to have happened mid last year. All right, they say a large part of the inversion seen in the U.S. yield comes not from high recession odds or for inflation normalization, but rather from low long-run real rate levels, end quote. And this is all from Goldman Sachs. So again, I'm not saying it's not going to happen. It could happen. Again, I'm pretty flat. If you guys know me, I'm usually a pretty active swing trader. All right, like I'm usually pretty active with regards to how much I swing trade. I haven't been swing trading a lot. I've been missing out on some gains, but I haven't been confident enough in the market to really want to take larger positions in that regard. You know what I mean? Like I haven't trusted the market. And so it's not like I'm against the shorts, but yeah, all good. Yeah, Baba has been flying up, man. Baba has been ridiculous. Look at Alibaba right now, man. Baba. Look at this rip yesterday. Baba went from $86 all the way to basically 100. It's sitting just under 100 now. So Baba flying up, gapping back down some. And again, there's a very contrarian nature of the market that people should understand, to be honest. There's a very contrarian nature of the market. This is what people really got to understand, is that the market rips up, a pullback the next day is likely. That's just standard market activity, I think. So not sure if you brought it up, but the news report was made on AMC by Benzinga, but was started by Charles Gasparino. In short, Amazon would only buy it for pennies on the dollar. Yeah, they're saying it's unlikely to happen. All right, so Wedbush analyst Alicia Reese thinks that Amazon is unlikely to buy out AMC. Amazon does not need 10,000 screens to enter the theater business, she said, adding that Amazon would be better off buying a piece of Cineworld Group, the UK-based movie theater chain that filed for bankruptcy protection last year. AMC positioned really well for 2023, says Wedbush. Amazon could buy 1,000 screens for 200. Could buy 1,000 screens for 200,000 a screen, or 200 million. Why would Amazon instead choose to buy 10,000 screens for $8 billion? Bottom line is that Amazon has no interest in being in the theatrical exhibition space to make money. AMC describes itself as the largest movie theater chain in the world, approximately 950 theaters and 10,500 screens. The going rate pre-pandemic was 250K per screen. Cineworld bankruptcy, Amazon, and she said, this is quoting her, she said, with Cineworld bankruptcy, Amazon can probably cherry pick screens for 200K, and the creditors will grab an offer like that. The analyst does not think AMC is likely to acquisition target in general, given its $4.6 billion of debt. If AMC is acquired, Reese thinks that the company's IMAX domestic footprint would remain safe. I like IMAX. AMC stock is up 26% in 2023. Hasn't really gone up that much, man. Yeah, but yeah, I guess it has. In January, Amazon was at 390, 370s. It's currently at 515. So, hey, let's see if it moves up. I'm rooting for it, man. I hope AMC does well. I hope it goes up, you know. Here's the SPY. SPY just making moves today, man. I like to imagine A.A. Ron as a rock star with big angel wings. Yeah, he's like the movie Michael with John Travolta. You know, that's Adam Aaron. AMC at 515. So let's see if it actually holds. My other question is, why is the market up so much right now? Like, it is up pretty big amounts here, man. Big rips. Bank's not really up that big. I know we dipped yesterday and before the I know it dipped yesterday before the I know it dipped yesterday before the market closed, but big, strong pre-market session, man. I mean, the market started to rip up yesterday. Looks like most of this rip actually came from yesterday. So the market gapped up big. My question is, what was it? Was it Barr's house testimony on, was it the house that he spoke at? Was it Barr's testimony regarding banking? Was it that? He speaks at 10. We're going to cover that today. We got Barr speaking. We'll probably cover that today. We also have pending home sales. Yeah, I know Netflix is up. I see Lululemon up. I'm sure we're going to have... We used to have a dude that really liked Lululemon, but the problem is he was like really weird and obsessive with the channel in that regard. But he really loved Lululemon. And so I'm sure he's going to try to do something today. But like, if anybody actually listens to what I say about Lululemon, I've said it many times. Lululemon makes bank right now. They make tons of money right now. The fear is not holding Lululemon over a year's period. The fear is what will happen to Lululemon over the next 20 years. That is the bigger fear, I think. I think over time they will see a slowdown. But right now, obviously, as I've said a bunch of times, Lululemon makes tons of money right now. Again, I have two, like my daughter and my wife love Lululemon. I see them buy it all the time. And so I understand Lululemon is definitely succeeding right now. But just in terms of like a general, like 15-year retirement investment, I think it's a terrible idea. I think Lululemon is one of the more speculative companies that's fashion related, that's trendy, and that, you know, there's a chance that companies like this and, there's a chance that companies like this eventually go out of business, regardless of how much money it makes right now, regardless of how good its earnings were. I think there's a difference between looking at obvious strength right now, current times, which is something that I've been very open about, which is that Lululemon is very strong right now, like very strong right now. I'm not worried about Lululemon anytime soon. What I'm worried about Lululemon is 5 to 10 years. Will it be as big as it is now? I don't think so. I think it's going to lose its flashiness, and I think over time it's fashion. I think there's going to be another brand that pops up that ends up kind of eating its lunch, and Lululemon slowly starts to fade into obscurity. I think that might happen. Again, I'm not saying it's going to happen, but I think in terms of investing for retirement long term, I think it's a risky one. But hey, let's see if it makes money. Yeah, I love the lakes, man. The lakes are cool. And acquisitions such as that would corner the market on video entertainment. They did buy MGM already. Theory is stronger than 2 years ago. Amazon might buy Crocs. Bro, Crocs are killing it, dude. I didn't even know how good Crocs were doing, bro. I really didn't. I had no idea Crocs were doing as well as they were. Yeah, I had no idea Crocs were killing it as good as they were, bro. My daughter loves Crocs. My son loves them. Bro, somehow Crocs went from like $20 a piece to like 70. Crocs have gone up 300% basically or more in value over the last like 5 years. What is going on with Crocs, bro? Like somehow Crocs went from what was dubbed the ugliest shoe ever to being like a fashion statement right now. You know what I think happened? This is my guess, okay? I have children, all right? Bro, when my son was 2, we used to slap Crocs on him everywhere. He would be wearing Crocs. Oh, we got to go to the store, Jack, put the Crocs on. Maddie, we're going to the store, put the Crocs on, right? So I think my kids, and I think a lot of kids in this generation grew up wearing Crocs. And so while adults are still going to look at most Crocs like those are the ugliest shoes ever, Kids grew up wearing them at this point, and so now they're part of their life. They're kind of like my generation's Doc Martens or slip-on, whatever they were called. I can't even remember what the little slip-on shoes were called, but we had them. I remember. I'm showing my age a little bit with that comment, but yeah. Kids grew up wearing them now, man. Now Crocs are cool. Freaking almost $100 a piece. You know, my wife bought my mother-in-law, a pair for Christmas, I think. And bro, those things were like $80. Yeah, they were troll gifts, Chris, is what they were. Yeah, they were troll gifts. They were saying, hey, we're going to buy you some Crocs because their Crocs are ugly and we're going to buy them. Ha ha ha. Now they're $80 a piece. The Crocs got the last laugh, I guess, man. You know? Yeah, probably, boss man. Do we have bots? Yeah, they've got what do they call it? They've got little dazzlers that you could put on. My son's got some like baseball ones and stuff. My daughter has some baseball ones too. I'm not even mad at it, bro. Let Crocs do their thing, man. I'm not mad at that. All right. So I'm definitely not buying anything right now. I think the market's a tad bit extended for me up here. Charms. Yeah, they've got their charms. All right, guys. SPY at 399. We got AMC at 517s. They offered one free peer-to-peer minutes during COVID, but never delivered. Oh, that's not cool. $7 minutes until 7 a.m. Honestly, the market volume's been light. I've been looking at a daily chart, bro. We've had the lowest volume in weeks. Yesterday, we had one of the lower volume weeks. The last week, yesterday, we had lower volume in the market total. All the way back to February. Early February was the first time we had lower volume than we did yesterday. All right, guys. So yeah, market pulling back. AMC had 520s here. We'll see if we bounce. All right, guys. So all right. So yeah, SPY at 399. All right, guys. So AMC dipping down a little bit, and we are in AMC right now. So we are in AMC. Um, 399 on the SPY here. Hey, my guy, bad. Thank you, brother. Yes, I can see your chat, Jeremy. No, I didn't short AMC. Bro, I'm not shorting AMC. I just think that's risky. I don't even think its shorts are available for me on here. Hey, but thank you so much, Bad. I appreciate you, brother. Thank you, man. SPY on the VWAP. What makes you want to buy? No, I'm not buying it right now. We're way too high up here for me to buy the SPY currently. Again, we are way... Look at this gap. This gap is way too large for me to really want to buy this here. Just too big, man. Too big of a gap. All right, so 399. The question I have though is like a lot of the time when we get up to these levels here, like a lot of the time when we get high up like this, $400 psychological levels, kind of like a magnet. Like it can be like a magnet here. So sometimes when we get up to these levels, it can be like a magnet, and we'll see. But yeah, I mean, what is the fear regarding BRICS? Which, if you don't know, stands for Brazil, Russia, India. It's Brazil, Russia, India, China, and South Africa. Yeah, I mean, what's the fear? The petrodollar, them getting off the petrodollar. BRDS, man, I'm not really much of a penny stock trader, brother. So I appreciate the donation, but I'd rather just be honest with people. I'm not really much of a penny stock trader, bro. I think when you look at the daily chart, it tells the story of a stock like this, and maybe it's strong, maybe it ends up succeeding, but like, I don't know. It's hard to argue. I'm gonna give my honest truth regardless of it, brother. I hope you understand. I'm not trying to like rag on your stock, but that's the daily chart. It's a pretty rough looking daily chart, brother. This thing has gone from 260s all the way to 20 cents, 10 cents at the lows over the last couple weeks. It's pretty rough looking. Again, I'm not saying it's gonna fail. I'm not saying that, but it's looking rough, man. No, I'm in for a scalp. Hey, good luck, man. Hey, scalp's fine. You can make money doing that. It's gapping up nicely today. Just broke over VWAP. I hope you make some money, bro. Bricks. Where's Gucci Mane at? All right. Mullen at 10 cents. I tried to tell everybody on Mullen, bro. Nobody ever listens, bro. I don't know how many people have pumped Mullen here over the last couple weeks or over the last year, really. But it's just kind of like Mullen. The problem with Mullen is that it's an obscure EV company where most of the big EV companies are going to fail except for Tesla and NIO, I think. Maybe not, but like there's risks in that regard. I blame the Wolf of Wall Street movie. Yeah, kind of. I mean, honestly, the Wolf of Wall Street. The Wolf of Wall Street movie is. I just see so much irony with that movie. There's just so much irony with the Wolf of Wall Street. The irony is that like Leonardo DiCaprio, right? He talks about how people like Jordan Belfort are the worst people in the world. But I can't help but see the true irony of this movie here, which is that, bro, like, okay, so you think Jordan Belfort is like the worst guy ever, right? You think he's just like a terrible person, or he was a terrible person. I don't know what he is now, but you think he was a terrible person, right? But you create a movie here that basically glorifies it. Like, bro, how many kids watched that movie and said, man, what a bad guy. I don't want to be like Jordan Belfort. No, bro. Every 18-year-old in the world watched that movie and says, damn, I want to live like that. 100%. I know I did a little bit when I watched it freaking a decade ago. And everybody else, I'm pretty sure a lot of other people did as well. And so, sure, the movie is about having bad ethics and bad morals and wanting and being too greedy about everything. But bro, that movie straight up glorified being rich, 100%. And it's basically that movie itself, just that movie alone. And I would say, regardless, or irregardless for my people who use irregardless, regardless of anything else, that movie created a bunch of Jordan Belfort clones. That movie basically caused a bunch of kids who watched it to be like, that's the life I want to live. It caused a bunch of people to get interested in the stock market in the same way, 1,000%. And so Leonardo DiCaprio can be all like, oh, guys, people like Jordan Belfort are the worst. Bro, the movie you just made created 1,000 Belfort clones. Like, be honest about it, man. Like, come on now. Don't say, oh, try to be all righteous, dude. That movie glorified being rich. And of course, the movie is about being too greedy and about how greed can cause you to do some stupid stuff. I understand what the movie's about. I like the movie. The movie's good. But y'all know what I mean. Everybody should know what I mean, I think he's a bad guy. But I think he's a great salesman. They glorified his salesman ability. That's where it was. So it's like they're making a bunch of Jordan Belfort clones, bro. Now what happened to Jordan Belfort, bro? Leonardo DiCaprio is like, hey, this is the worst guy ever. It's like, all right, well, where's he now after this movie? Bro, he was relatively obscure before this movie even came out, bro. Now he's out here on YouTube, selling courses. He's slanging courses on YouTube. He's being a mentor to thousands. And you got a bunch of people like, oh, Jordan Belfort's my mentor. Great. You and 1,000 other people, and so I guess my point here is like, if Leonardo DiCaprio really thought that Belfort was a bad guy, bro, you just put him in front of everybody. Like, you just gave him center stage. You gave him a platform, and now there's a million Jordan Belfort clones out there in the world right now. And so I just think it's funny. Looking back here, correlations. What is Soul Runner saying? Correlation with what? The market makers want it to go up, so everyone who bet it down will lose money. I don't think that's it. I think, look, I think sometimes when you get market weakness, it's really easy to jump on that bandwagon and say, hey, the market's going to crash. The market's going to crash. The sky is falling. The sky is falling. And it's really easy to jump on that bandwagon, so to speak. And I'm not saying we don't crash, but what I'm saying is, like, generally extension plays a factor and stuff like this. And so if you look at a 10-day chart, if you look at a 10-day chart, you'll see the real price action. I think a 10-day chart kind of clears up a lot of the nonsense. So despite all the doom and gloom, banking craziness, whatever people want to say in the market, this is the trend of this market over the last, 10 days. And so we actually have a slight upward trending market despite all of this stuff. And so, sure, one sector is weighing bad, specifically banking over the last couple of weeks. And it's definitely, been looking a little bleak. But what is more likely is a recession, not a crash, right? So, like, people brought up the yield curve inversion. And I guess what I'm trying to say is that somebody said earlier that we have to crash because the yield curve is inverted or something. I can't remember what they said. But again, I'm here to tell you that that's not true. Okay? What happens is that generally a yield curve inversion means a recession could be in the future. It doesn't mean it has to be, but every recession has been preceded by a yield curve inversion. And so what that means is that it could be a sign that a recession is coming, but it doesn't mean it's for sure. So basically, every time the yield curve inverts does not mean we have to have a recession. All right. But every time we have a recession, it does precede, the yield curve inverting does precede it. Okay. So that means that when we do have recessions, it's usually preceded by a yield curve, but it doesn't mean it's a for sure thing, if that makes sense. So basically, it could mean a recession is here, or it's going to be here. And I think the time that when I looked it up, what's the lag in between the yield curve inversion and the recession? It's generally on average 235 days. Or in 2007, I think it was 235 days. So you had the yield curve inversion, and then 235 days later, you had the 07-08 financial crisis. That's what happened. But again, the point is that it's not an absolutely for sure thing yet. And it could happen. I'm not saying it won't, but it could, Right. The ironic part is that, yeah, dude, I noticed that as well. Pond says the funny part is that the Belfort wannabes are buying the crap he was promoting in the movie. I don't know how many Stratton Oakmont videos and shorts I've seen out there on social media. They're like, yeah, join the new age, Stratton and Oakmont. Buy Mullen, and set your financial future. You know what I mean? And it's just total crap. Like, these are terrible companies. And they don't understand the irony there, which is that everybody watches that Wolf of Wall Street movie. Leonardo DiCaprio is like, hey, this is a terrible. I made this movie to show how bad Jordan Belfort is. Ultimately, just creating a bunch of Jordan Belfort clones once they watch that movie. And then the even larger irony is that Jordan Belfort got in trouble for pushing terrible pink sheet stocks to people over the phone. And now the same people that look up to him and want to be him are buying terrible pink sheet stocks, and just penny stocks in general. And so there's just a lot of, I think you got to laugh at it to a certain extent. again, you want to know what I preach about regularly on this channel? I'm trying to protect traders from turning into the people that Jordan Belfort had on the phone, you know? And I think there's a lot of them. But it's an interesting thing for sure. Honestly, I'm kind of mad, bro. I got my real estate license, bro. They say I need more. Freaking. Like, my license is back active. Or back inactive. I'm sorry. My license is inactive. But now I got to do some type of continuing education. I'm trying to see how much I actually need. I'm going to have to call Trek today once this stream is done and then figure out how much I actually need. John, please tell these newbies that uncovered puts are not for speculating on a downtrend. Puts are for selling large positions and protecting, insuring against downtrend. Yeah, I mean, y'all can use them in either way. There's just risk on the other side. AMC to the moon. That's right, at Raphael. Thanks, bro. Hey, I'll be right back, guys. I'll be right back. All right, we are back. Hey, what's up, D? Yeah, well, I wasn't there. I'm back now. All right, so I got to do 18 hours of CE courses per license period. I'm not going to say I'm going to do them while I'm on stream. I'm not saying I'm a great test taker, but I'm definitely one of the top 3 test takers ever. You know, when I originally got my real estate license, like, I was signing up for Keller Williams. And at the time, Keller Williams was like, hey, most people fail their real estate exam, you know, when they take it. And so, honestly, it was actually easier than I thought it would be because, you know, when you're the top 3 greatest test taker ever in the world, you know, things just come easy, I guess. But no, I remember the person that I was talking to was like, yeah, most people fail their real estate exam. I literally got my real estate exam in my real estate license in like a week and a half. Like, from the point where I was like, hey, I want to get my real estate license, to the point where I actually like got to like pass the test and basically got my license was like a week and a half to 2 weeks. So in Texas, you could actually get it pretty quick. I think they changed the rules now, though. The rules used to be like, I paid about $1,000 on Champions online real estate, and so I just signed up for the coursework online. Finished that within a day or two, and then once I did that, went and took my exam, scheduled my exam, went and took it, passed it, and then got my license. But right now my license is what they call inactive. So I have to get a broker, but they say I need some type of CE, which is continuing education. So I'm gonna have to figure out what I got to do on that front to get it. I took it once. I passed it the first time. 6 months for real estate? No, I don't think it's that long, bro. Hold on, let me see. I got a lot of family members. If you ever need a realtor in Louisiana, bro, I know a lot of real estate agents. I have family that are real estate agents. My aunt, my cousins, my uncle, all of them are real estate agents. They own their own brokerage in Louisiana. It can't take that long, though. I don't know if there's a difference between Louisiana. Yeah, I don't think this doesn't seem that much different. You have to have a high school diploma or GED. I think that's the difference here. I mean, I have, I graduated from high school, but bro, the way I graduated from high school is actually I'm kind of sad it happened the way it happened. But I graduated from high school, but I'm kind of sad it happened the way I happened. I was kind of like, I'm not gonna say I was a screw up kid when I was younger, but I definitely made some dumb decisions when I was in high school. Definitely made some dumb decisions in high school. I'll go ahead and tell the story. So when I was in high school, seniors, they're supposed to let them out early, right? Seniors are supposed to get off at noon because, frankly, you don't need that many courses. Like, you don't need to take extra classes. Seniors are supposed to get out at noon. That's been the standard for seniors all across the country, in my opinion, everywhere you go. But for whatever reason, my school at the time, and I'm not going to tell what school I went to, but my school at the time tried to make me stay until 3:30 every day for like SAT prep. And so every day I was just kind of like, nah, I'm not doing that. Every day I would check out. I would check myself out. I think I would forge my mom's name is really what I would do. And I would check myself out. And I would leave the school. I would check myself out at like 1 every day. My friends would come pick me up. I'd drive home, hang out, live life. As a senior should be able to do. Now, I got away with it for like the whole year. My whole senior year, I got away with it. Bro, my school came along and got really petty, and they kicked me out within like a month. Like really, it was like 2.5 months before I was supposed to graduate. And so they kicked me out. But to be honest, my parents were kind of on my side. And so I ended up just going to summer school, getting the half a credit or whatever it was that I needed to graduate. And I graduated before the rest of my class, but I didn't get to do a graduation ceremony, which I'm still kind of bummed that I didn't get to do. But like, that's what happened when I was a kid, but yeah, definitely dumb mistake. Yeah, Raul. Hey, what's up, Raphael? Top 3 dumb decisions of the world by me by far. I mean, I still got my high school diploma, and so it ended up working out. But yeah, terrible decision at the time. I think I was just stubborn and I was young, and I was just dumb. I was stubborn. I was impatient, and honestly, I was a senior, man. My dad did a really weird thing for me. So my dad used to make me go to summer school every year because I got a C. If I got a C in school, my dad would send me to summer school every summer. I went to summer school, basically. I literally took a lot of courses and classes and subjects twice because I got a C in them. And so every time I got a C, my dad would make me go to summer school. If I got a D, I definitely had to go. So I went to summer school every year in high school, literally every year. Never had one summer off. And so, yeah. And looking back, it was probably a good thing, to be honest. Like, it reinforced a lot of topics and subjects in my head. But at the time, I hated it. Bro, this ain't the Sandlot hat, dude. This one's not the Sandlot hat. The bill of this is not super. This is actually kind of a small bill. You know, this is a trucker hat, if you will. You know. Seniors do, Rick. Seniors get out at 12. Their senior year, they get out. They're supposed to get out midday because they don't need the credits senior year. Do you have BRDS on your radar? No, BRDS looks like a sketchy penny stock that I'm not touching, bro. I don't care how much it's up. Somebody bought it earlier and made money, but for me, again, it's just not really my style of trading. I'm just not really interested in that. There's too much risk in buying that and letting it come back down. The Sandlot hat in Paris. What it had official? It had like a barracuda on the Sandlot hat, right? Yeah, SPY bounced it a little bit back over the VWAP. It's at 399. AMC's still struggling right there. It's at 514s. So it's still trying to, but is Natty Gas a good buy right now? I don't know. The problem with buying up Natty Gas, Harry, is that these are long-term depreciating contracts, correct? So like over the long run, this is going to go down. No? Somebody correct me if I'm wrong there. Doesn't time decay play a factor in Natty Gas, ETF, UNG? I was a professional musician at 15, so my parents left me alone. Also, we rented a big building downtown. I was kind of nerdy when I was a kid. Like I used to, I would, I was kind of nerdy when I was young. Like when I was like from 10 to 15, I was very nerdy. Like I basically would download video game emulators and ROMs, but it taught me how to use a computer, you know. And so I would download like video games and get them before they got out. I got in a little bit of trouble for downloading one of the Star Wars prequels before it came out in theaters. I got in trouble because they sent my dad some type of cease letter. I had LimeWire, I think, at the time, and somehow I was sharing the prequel Star Wars movies in 2001 before they came out in theaters, and that made the theater mad, I guess, and sent my dad a cease and desist letter of some sort. And then I also had like a Legend of Zelda fan page that I created when I was like 12. Website. It was like a walkthrough website. I remember it. It was like Zelda walkthrough online. Really nerdy stuff looking back on it. But hey, taught me how to use the internet. Yeah. SPY at 399s here. Yeah, for sure. LimeWire. Bro, my computer was just kind of like, what are you doing to me with this? LimeWire, man. A lot of people remember Napster. They don't understand LimeWire or Kazaa. You know? Or I don't know how you pronounce it, if it's Kaza or whatever it was in LimeWire, and there's a few of them. Yeah. Rebalancing decay, yes, they completely did away with the UNG 3 times leverage. Yeah, what's up, Jason? Are we back in bull mode? I don't know, man. Mark is ripping up today. AMC's ripping up today. We got the SPY at 399. So I'm trying to figure out why the market's gapping like it is, though. Is there any justification for this gap up is my question here. Like, what's the reason for this gap? Reverse articles. Yeah, you thought you were downloading a Nickelback song, and then, some other stuff came on, and you're just like, whoa. Well, what's the reason for that, Joey? Is that news right now? Yeah, I learned a lot back then too, Jason. Those emulators and ROMs taught me a lot about like zipping things, like files, extraction, um, just a lot of different stuff. Coding, I had to learn to teach myself to code, mostly HTML, as a kid. So there's an article on Yahoo Finance blaming the banking issues on social media. Well, we're just at the age now where news travels really fast. Yeah, I remember doing the same thing. Zune, man. Zune happened a little bit later. I had a Zune iPad, Zune MP3. I don't know. I'm looking for the reason market's up. It could be from Barr speaking. It could be from I'm looking at other news here. It could be just from tech, I guess. I think MU had a good earnings report, right? So MU's so cheap right now. Or no, Unity. Look how cheap Unity is. MU I think had good earnings. Lulu had good earnings. The Barr meeting was whack. Honestly, nothing relevant. We'll try to stream the other path today. John, back then, were you? I remember N64 ROMs. I got them to work eventually, but I remember it took a long time. It was just hard to find real ones. Like they would say it's real, and then you download it, and then it would be like a Game Boy ROM or something, and you'd have to delete it. I would get I could get the N64 to turn on, but play games was a different story. I got it to work. Like I had Zelda Majora's Mask like before it actually came out. So I remember I got it to work. I had all the Pokemon games too. But I remember it was tricky for the N64 ones. Oh, interesting. AI. Yeah, I had Final Fantasy. Yeah, there was a lot of them. I just remember, like I said, I had them a lot. I mostly had Pokemon ROMs. You know. All right, guys, SPY right at this 399 level. Just a huge rip up in pre-market today. Let's see if it actually holds. My logic is I think the market might pull back a little bit leading into the opening bell today. I think we might get a little bit of a pullback. All right, guys, and again, the SPY at 398.90s here. AMC up on a potential acquisition of AMC by Amazon here. Yeah. Are y'all investing in banks? Yeah. The next rate hike will be really interesting too. So the next rate hike decision is going to be in. So the last one was mid-March. So I think it was March 22nd. So the last one was exactly a week ago. The next one will probably be in May. So early May, I think, is when the next one will be. And again, that'll be interesting. Well, I wonder what the Fed's going to do. We also have CPI. Let me get the music going again. Back to the moon. I bought some banks. I'll hold them as long as needed. I feel you, man. I get it. Are you buying the big banks, Cal, or the small banks, man? Big banks are understandable for sure. Small banks are, I'm not touching them. Yeah, I hear a lot of people talking about the AMC news is fake. One thing I've learned is that you should never buy a face cream online. You should never, ever, ever buy a face cream online. One time, let me tell you a story. One time, Carol was watching TV late at night, and they had this face cream that come on. And so Carol, late night, this is when I first met her, like 10 years ago. Carol decided to go ahead and buy this face cream. She called the hotline. She buys this face cream. And they spit out this contract, and she agrees to it. And the whole time, I'm like, nah, don't do this. Carol, do not buy this face cream. Carol's like, no, I'm buying it. And so I'm like, all right. The next month, this company charges like $600. $600 they charge her. When she goes to cancel it, they refuse to cancel it. They say, no, you're locked into this contract. And monthly for $600 for this little bitty vial of face cream. Man, that's how they get people, bro. Never buy from a late night infomercial. Never, ever. If they were reading you a contract just for buying something, you do not want to buy whatever it is. Sorry, the reason I'm seeing this is because I'm seeing a Twitter ad about it right now. All right, guys. SPY back over 399. Let's see if it actually holds this spot. All right, guys. Again, SPY at 399s. Yeah, AMC ripping up. I'm in AMC. I hope it continues. Yeah, I got you for Tesla here. We'll put Tesla up. Yeah, pending home sales data today. We also have the Barr bank testimony and thing going on today. We'll try to stream that too. All right, so SVB, they say, quote, so in a prepared testimony released on Monday, Barr, which is the Fed's vice chairman for supervision, he basically talked about how Silicon Valley Bank's leadership failed to effectively manage interest rates and liquidity. They said Silicon Valley Bank's failure, and this is all quoting from Barr yesterday. He said, quote, Silicon Valley Bank's failure is a textbook case of mismanagement. With the Senate Banking Committee, they pointed out that Silicon Valley Bank's efforts to fix its balance sheet only made matters worse. They waited too long to address, and this is again quoting Barr. Barr said, quote, the bank waited too long to address its problems, and ironically, the overdue actions it finally took to strengthen its balance sheet sparked the uninsured depositor run that led to the bank's failure, end quote. And basically, Barr said that he also said that there was inadequate risk management. He saw social media saw a huge surge in talk about a run, and uninsured depositors acted quickly to flee. So he said, quote, our banking system is sound and resilient with strong capital and liquidity. He said, quote, we are committed to ensuring that all deposits are safe. We will continue to closely monitor conditions in the banking system and are prepared to use all our tools for any size institution as needed to keep the system safe and sound, end quote, from Barr itself. He had questions following that. Based on potential red flags at Silicon Valley Bank, Fed launched a review of oversight of the bank. Barr is leading that review. He promised to take a, quote, unflinching look at them. He also said that at the end of 21, bank supervisors saw deficiency in the bank's liquidity risk management, and that resulted in 6 supervisor findings linked to Silicon Valley Bank's stress testing and liquidity, contingency funding, and liquidity risk management. In May of last year, supervisors issued 3 findings related to the poor board oversight and risk management weaknesses. So he said bank supervisors took further steps last year to show regulators were aware of problems. And so, yeah, they're saying, I understand social media, how that can kind of start this domino, like, fear. Barr also speaks today. I believe he speaks today as well. So I believe he's going to be speaking today also. Not 100% sure. I'm pretty sure. I'm going to stream it today as well. So yeah, I think Barr is speaking today. Yeah, so Barr is speaking today on bank oversight before the U.S. House Financial Services Committee. I think. We'll stream it if we see it. All right, guys. SPY still at 399s. AMC still right at the previous closing price, kind of flat and break even here. If Boyle does a reverse split, currently trading at 348, how bad would that be to shareholders? I've lost 50% of my portfolio in past reverse splits. Well, a reverse split is just going to consolidate shares and make shares more expensive, Lynn. And so they should equal out. Having to do a reverse split is not a good sign, though. Generally, companies have to do reverse splits when they are getting NASDAQ listing requirement notices, like delisting potential notices, if they don't increase their price. And so it's usually kind of a desperate move for a company to do a reverse split in that way. I'm not saying that's what's happening with Boyle, but yeah. Gas, they delisted. Yeah, Boyle is a gas ETF. Yeah, I mean that's probably, that's what I'm saying. UNG. Well, there's a time decay factor here. SPY's still up at 399s. Yeah, but to be honest, I'm not the biggest expert in natty gas ETFs. You know what I mean? Yeah, so like Murphy said, leverage ETFs will always go to zero over time. Yeah, bar today at 10. We'll stream that. Yeah, all good, Lynn. No worries. A little bit better volume today, it looks like. Market's moving up. All right, guys. So all right, guys. SPY up to 399.10. All right, guys. So again, Tesla popping up, dragging the market up. SPY up to 399.14s here. What other stocks are moving up? Netflix. I should have held Disney, bro. Disney, yeah, it's up a little bit. Netflix hitting 320s, still not doing as good as some other stuff. Q, so tech related, is doing great. Q's up to basically 310 right now, which is very, very strong. Amazon gapping up as well, up to basically 98. Again, that $90 level for stocks like this is shown to be a pretty solid little level there. All right, guys. Again, so you can see AMC actually still popping back over the previous closing price. SPY at 399 is looking pretty strong here. I'm curious if we're going to break 400 today. Looking at the poll, 54% of people say no, the Amazon acquisition is not eventually going to go through. Still, 47% of people still think it will. How many times is bull reverse split? Market is definitely bullish right now. It's definitely gapping up a lot. And again, in a world where everybody's telling you the market's about to crash, I'm not going to say I told you so, but, you know, sometimes it's just hard to be as right as I am. You know, when you're right, you're right. Sometimes I'm just the greatest, top 3 most accurate traders in the world right now. All right, so Jim Cramer said Baba, basically bearish on Baba. Baba is ripped up since he said it, dude. It's honestly surprising. Jimmy is Cramer, September 476. I'm bullish on Rome, he said. Oh, there's some hilarious memes. All right, guys, SPY up to 399.20, still ripping up. I'm going to zoom in a little bit just to see this. Look at this gap on the SPY. Huge move up here. Look at the SPY gap here. Very strong. Tesla up to 192s. Hey, Carr, what happened, bro? Didn't you say the market was going to crash yesterday? SPY was pretty flat yesterday and then just had a huge green day today at 399. Thus, the point remains it's irresponsible. All right, guys, SPY up to 399.20s here. I guess I do think the momentum's a little bit on the downside today. I think we've gone up so much that like a pullback is certainly possible. I'm not saying it's gonna happen, but I think it's a little bit more possible now. And again, I hope we continue going up. I hope I'm wrong here, but you know. All right, guys, SPY at 399.08 here. AMC at 515s. Short to get open. Oh, well, yeah. I mean, you could say that's what you said, but, you know, in the end, I think the overarching point is like calling for a crash every day is just, you know, it's just unnecessary, man. Maybe we hit a recession. A recession's possible, but when is that going to happen? Who knows? You literally said dump it. You didn't say it should. You said dump it now. E-mini just hit 3999. Dump it now. This market is not for buying. It's for selling. Sell, sell. Do it now. Sell and dump. I could pull up receipts. That's the problem here. Most people don't realize this, but I can look back at the entire chat history. And so the overarching point is that if you're going to come here, Carr, and you're going to tell everybody to sell, tell everybody the market's going to dump, and then the market rips up, bro, you better be ready. Because I'm going to never let you hear the end of it, man. It's all good. But as long as you're okay with that, it's all good here. Let me put the music up. Bro, I'm running out of coffee earlier and earlier every day. I'm out of coffee already, bro. It's not even 7 o'clock. That's bad, right? If we all join together and buy the market, it will have to adapt. I mean, I get your logic here, but what you got to understand, brother, is that what you got to understand is that we're not moving the market at all in that regard. Apple, Amazon, Disney, Tesla have billions in the float. We could all buy Apple at one time, literally at one exact time. We could all say, hey, we're going to buy Apple right at 7 o'clock. And I'm not telling you should. Don't buy Apple. I have no idea what's going to happen. Maybe it crashes. I'm sure Carr thinks so. But we could all buy Apple at one specific point in time, and Apple would not move at all. All right, the float is frankly too large for us to have any major influence over anything. Yeah, what's up, Emmanuel? The point is, Carr, here's the point, man, is that you come in here screaming, dump it, sell, pressuring people to sell, pressuring people to sell, pressuring people to sell, and then the market goes up. That's the point, man. And the point is, just don't pressure people to do anything, man. I'm not saying the market's not going to crash. I'm not saying we're not going to hit a recession. I know the yield curve is inverted. But again, that doesn't necessarily mean we're going to crash. And so pressuring people to do one specific thing just causes emotion. And again, it's something that I got to call out here because again, if anybody really watches this stream and understands me, I don't there's a few rules. Don't pressure people to do anything, Always tell people you never know for sure. Never pressure people to take trades. Don't push sketchy penny stocks, and don't shill courses or mentors. Those are the big 5 things that I'm going to frown on. And so I guess the overarching point of all of this is stop pressuring people to do stuff, man. In the end, nobody knows what's going to happen in the market. And that pressure is not helpful. It just causes, problems. Yeah, the reality of it is the SPY is actually completely flat here. If we look at a 180-day chart, we're basically completely flat. 180 days ago, so 6 months ago, we were about $15 lower than where we are. So we're slightly green over the last 6 months, but not a huge green move. We're actually very flat. Last 10 days, we're slightly green. 20-day chart, we're basically completely flat. 180-day chart, again, we're slightly green. Yearly chart, we're slightly red. Weekly chart, obviously, we're super green, Ruby rod. But But yeah, so in the end, the market's actually pretty neutral right now. And maybe we crash. And maybe the inverted yield curve is going to signal an upcoming recession. But maybe not. Again, every time the yield curve inversion happens, it does not mean a recession is 100% going to happen. It could signal that. It could mean that. But generally, that's not going to be a crash anyway. And so it's one of those. We're in one of those situations where it could happen. It's potential, but acting like it's a for sure thing and like it's imminent every day, it's just not helpful. Oh, dude, I will pressure you to not pressure people all the time with heavy pressure. Top 3 pressures in the world right now. Yeah, hit the like button, guys. I appreciate it. Hey, bud. Love you, buddy. How you doing today, man?
My leg is really hurting.
Why, man?
Yeah, I think I pulled a muscle.
You pulled a muscle? I'm sorry, bud. Here, I don't want people to see. All right, I don't think they can see. All right. All right, buddy. I love you, man. You have a good day, okay? Love you guys.
Love you too.
All right, love you.
Love you. It's nice and warm in here.
Yeah. I had fun playing Halo yesterday, man. We'll try to play again today, okay? All right. Love you.
Love you.
Love you guys. All right. I'm feeling really pressured right now. I'm top 3 pressures in the world right now for sure. Definitely top 3. I've worked hard. I've put a lot of pressure on myself to be one of the top 3 pressures in this pressure-ridden world right now. Nvidia, where's Nvidia at? Nvidia pulling back to 260. Nvidia, it's just too strong right now. It really is too strong for me. I know it's kind of break even on the year, but it's up from 108s to 275, 264s right now in the last year. Yeah, well, with all the craziness going on in the world right now, you got to tell your kids you love them, I saw Bitcoin bounce back too here. So Bitcoin all the way back to 28.5K. So Bitcoin has been flying back, which is great. Great news. Crypto volume and liquidity is just great. That's what we want to see. Hey, thank you, Wholesale Benny. I appreciate it. Hey, yeah, thank you, Grape. Thank you, Z. I appreciate y'all. Love you all too, man. I appreciate the support. I really do appreciate the supportive people here. Again, I don't want to seem dramatic. I'm definitely top 3 most dramatic ever, but yeah, like I said, there's a couple things that'll rub me the wrong way. But as long as you don't do these 3 or 4 or these 5 things, really, like you'll probably last a long time and not get banned here. The biggest way to get banned is if you pressure people to do one specific thing. If you pressure people to buy or sell, like really heavily, right? Like it's one thing to say, hey, I'm bearish, or hey, I'm bullish. It's another thing to say, sell now, do it now, sell now. Like, you know what I mean? Like that's a completely different thing. And that's not helpful for anybody. It just shows emotion. And again, a lot of the time it's wrong if it's shown anything. The second thing is don't pressure sketchy penny stocks, especially telling people to buy sketchy penny stocks, because most penny stocks are terrible companies. Telling people to invest in them is usually going to be a losing endeavor for those people. All right. The third one is don't act like an expert. Don't try to say I told you so too much. You can say, hey, man, I called this. You say it over and over again, multiple days, every single day. you're probably going to get banned eventually. That's not helpful either. Because again, it turns into this really vague thing where I give out 5 different predictions. I say, yeah, the SPY could hit 400, the SPY could hit 395, the SPY could hit 390, the SPY could hit 385, and then if the SPY goes to 390, it's like, aha, see, look how great I am. I called that. And it's like, yeah, well, you called 4 other things too, and of course, one of them is going to happen. You know what I mean? But I digress. The point is, don't be too desperate for validation here. I'm definitely top 3 best validators in the world right now, but that's the other rule. The other one is don't sling or sell courses or encourage people to sign up for sleazy courses or all that stuff. Don't pump up mentors here. We don't need any of that. I can't vet them. And then the other one is just don't stream. If you stream at the same time as me and then come here trying to bring people, you are going to get banned very fast. Very fast. So those 5 things. You don't do those 5 things, there'll be harmony here. Hey, my guy, thank you for the donation. What price do you anticipate AMC could rise to this week before it bottoms? I don't know. It depends on what happens with regards to the Amazon deal potential going through. AMC, this could spark a potential squeeze here. I know the short float of AMC is still around 20%, and this could pop up and stop some shorts out and cause potential higher action. It's definitely going to make more people interested in it. I don't know what price we're going to hit, though. I have no idea what's going to happen. Nobody does, and I'm always trying to be honest about that. I really have no idea what's going to happen. Oh, I'm definitely top 3 rankers in the world right now for top 3 IJ. Okay. If you don't think that, I mean, you're top 3 most wrong traders in the world right now for sure. Yeah, for sure. Amazon would be better off buying Cineworld. I hear that, but I'm sure they would rather keep it local. Cineworld is UK based, right? They have theaters in the US, don't they? Yeah, we're gonna stream the Barr speech too, Florida. So yeah, we're gonna stream the Barr speech too. So don't worry, we'll cover that. But yeah, thank you so much for the donation, Wolf. Again, I try to be as honest as I can, bro. Hope you understand. I have no idea what AMC is going to do. I hope it goes up. I'm holding AMC, and I genuinely hope it goes up. But as for whether it will or not, I just don't. I don't know. I hope so. Also, guys, well, we got a couple people here. Again, this is the first plug we've had all day, and we've been streaming for almost 2 hours now. So again, if you want to day trade, the easiest way to day trade the market without taking on too much risk, the easiest barrier of entry with day trading, where most day traders, if to day trade, there's something called the pattern day trading rule. That means that if you want to day trade stocks actively, you need at least 25 grand to day trade more than 3 times a week. Sucks. It restricts most traders from day trading. A large majority of people are not going to be able to day trade stocks in that regard because of the PDT rule. The loophole here that a lot of people don't know about is the futures market. The S&P 500, which is the SPY, it's something that you see me trade regularly, basically every day. You can trade essentially the SPY in futures, no PDT restrictions. You can day trade short, no PDT restrictions in futures. And you can see the E-mini here. It's the same exact price action. It's the same exact thing. You'll notice this middle is the same as this left. So same price action, same chart. And so with the E-mini in the middle here, you can day trade this, short it with a margin account. To do so, really, you need at least 10K. The E-mini itself is about $5,000. And so to trade more than one contract, you're going to need at least 10K. But a cheaper way to get started, and again, I lost so much money when I first got started trading because most day traders lose money. And a cheaper way to get started without taking on as much risk is a funded account program in futures, right? So they give you a demo on these funded programs and they test your profitability. And if you can hit the target, so the base one's 50K demo, if you can hit 3K in profit while following the rest of their rules, then they fund you 50 grand legitimately as a proprietary trader with a 90% split. So basically the reward is basically the same. You only miss out on 10% of that, but you're taking noticeably less risk. The base package on Top Step, the 50K one, is like 130 something bucks if you use my link and get 20% off. So it's just so much cheaper. So it's this perfect middle ground where you still have pressure to succeed. If you're good enough, you can get funded and still keep 90% of your profit. But if you lose, you're not losing thousands of dollars like you would if you put the money up yourself. And it's easier to learn how to trade in that way with much less risk, but it's a perfect middle ground of pressure. So it's something that I genuinely wish I had when I first got started trading. And again, you can get 20% off. They are a sponsor of mine. I'm definitely biased in their favor. But again, if you want to check them out, I will post this link. Great way to help support the channel. There's the link. Yeah, but a cash account's still not going to get it done. It's still going to be severely restrictive, John. Severely restrictive. You can do unlimited day trades with a cash account, but the what's called the T2 rule. It used to be the T3 rule, right? The T2 rule means that you have to wait 2 days between the buy and sell, or between your buy and your fund settling from the sell, right? So you could buy and sell a stock same day. Say you buy 1,000 shares of a $1 stock. You got to wait 2 days to get those funds back into your account. And so you're severely restricted with the cash account. You can, unless you're day trading penny stocks, and even still, you're going to be severely restricted by a cash account. Severely restricted. You might be able to day trade more than 3 times a week, but you're certainly not going to be able to day trade as freely and as accurately, or and as freely as you would in futures. Certainly not going to be able to. Again, I've done it all. Like my account right now, I don't need to get funded because, again, my Thinkorswim account's got about 40 grand liquid, about 160K buying power. So I don't need to get funded. But there's a lot of people who are going to find huge value in these funded programs because they're ultimately just taking less risk. No, it's not. It's the T2 rule is what it's called, RSL. It's not the T1 rule. It's the T2 rule. And so you have to wait 2 days for your funds to settle after each account. Yeah, for options, it's less. But even still, it's still severely restricting. You having to wait over a day to get your funds settled. In futures, you get a margin account, you get instant settlement. You buy shares of the E-mini, you get that. You get your account credited exactly when you sell. And again, the S&P 500 is what moves stocks. It's ultimately what moves everything. And so everything's influenced by. I trade a lot of these economic releases. Today we got the Barr speech. We got pending home sales at 10. That is ultimately that is stuff that you can trade in futures. And again, I think futures are just easier to trade. Like, sure, you could day trade penny stocks, but day trading penny stocks is incredibly difficult. And a lot of it is predatory, to be honest. Like, day trading penny stocks is just incredibly difficult. Day trading anything's hard. And I think most people are going to lose, but I think it's just a lot cheaper to lose a funded account than it is to put up the money yourself and lose your account that way. It's just saving money. Yeah, you can't short on a cash account either, so you're basically restricted to only one direction, which is even worse. And you should never be restricted to only one direction. There's so much bias that comes from only being able to trade in one specific direction. Like if I can only go long, I'm going to be way more long biased. I'm going to see patterns that aren't necessarily there because I can only go long. And again, it's hard to be patient and see things as objectively as you can with only one directional potential, Oh no, bro. Stock trading is not like crypto futures at all, man. Yeah, Mac, you know better, man. We're just not going to plug any other streamers or anything here. Yeah, and I'm not saying this is you, but if you're one of those guys that are literally just creating account after account, whether you're trying to troll me or not, even if you do get successfully troll me, again, it's just kind of telling on that person's life in general. Like if that's what they're spending their free time doing, they got to be struggling in their life, man. They've got to have a pretty unhappy life if that's what they're doing, Again, I might dislike somebody or something, but I'm not going to spend my time doing that. That just shows another level of I don't even know what the word is. Chat, let me know what the word is. But yeah. AMC, guys. Still trying to come back. It's at 517. I'm holding a little bit. My average price on AMC right now is $8, though. Do y'all think I'll ever hit the $8 average price? Because over the last couple months, I hope we do. I think we will eventually. I just got to be patient. But yeah, let me know what you guys think. Yeah, when's my birthday? January 1st of 2020. D. That's my birthday, bro. Your mother's maiden name is Bill. You know. Pam. My mom's maiden name is Pam Shroot. You know, Pam Bill Shroot is her name. All right, guys. SPY at 398.80. So dip it down a little bit here. Kind of consolidating between 399 and 398 something. Yeah, my security number is 3333334. You know, that's it. My dad's name is Tony. You know, he's Italian. You know, I don't know how the market's going to digest the Holmes data. We'll see. We also have the Barr speech that we're going to be talking about later on. We'll see how that goes too. All right, guys. So I'm trying to be patient, but the market is too extended for me to necessarily want to buy it up here. SPY at 398.80s. DNA sample. All right, guys. So hold on, guys. Bear with me. Oh no, it's trash day. Hello.
Hey.
All right, I will be right back. I'm going to see how fast I can take the trash out. I'm going to give myself 2 minutes. I'll be right back. Will I beat, what, 3 minutes? Let me get the timer up. I take a trash out. Will I beat 3 minutes of trash taking? All right. Get the timer up. I want to see how long I take for this. Wait, where's the... Oh. All right, so there's got to be another timer, stopwatch. All right, ready? We're going to get this done. All right. Will I beat 3 minutes? I don't know. All right, ready? 3 minutes is the time I'm giving it. All right. 3 minutes. 3 minutes is the time I'm giving it. I think I'm going to beat 3 minutes. Or should I go with 2? I'll do it 2. All right. Ready? Whew. All right, 1:40. Whew. All right, definitely top 3 trash takers ever in the world right now. Definitely top 3. Oh, definitely top 3. I mean, that's obvious. Definitely top 3 time trash takers in the world right now for sure. Whew. All right. Got my early morning exercise. Yeah, Bruce, my dog, is like, what is going on? You know, danger. Do you need my assistance? You know. All right. Just to put it in perspective, it's only 7:20 in the morning right now. Bro, Bill Perkins is out here just giving everybody these bets. 100K deal to... Bro, I need to get in touch with Bill Perkins, bro. This man's making huge bets. So he said 100,000. Bill Perkins just made a $100,000 bet with Sean Deep to 1 millimeter, 17% body fat via DEXA scan. I guess HRT, which I'm assuming he means hormone replacement therapy, is allowed May 30th, 2024. So he's got a year and a month to do it. Let's see what Sean Deep is currently looking like. Sean Deep, I remember he got deep in some of the World Series of Poker tourneys. Bro, what is Sean over here posting on Twitter? Picture of your bathroom, bro? Bro. All right, I gotta Google a picture of Sean Deep. Bill Perkins, the billionaire, though. Apparently, it's a Big Sean song, too. Can you put the dog in the chair and use AI to make it look like... Bro, if I put Bruce in my computer chair, bro, I would have no computer by the time I returned. All right. Tesla dipping down a little bit to the 200 EMA and the volume weighted average price. Nah, bro, I even closed my gate, dude. I not only took the trash out, I even closed the gate. I could have left the gate open. Do you think Sean Deep will be able to do that? I know Bill Perkins also did a bet with Jamie Staples. He did the same type of bet here with Jamie Staples, who's another professional poker player. And I think he actually did it. I think Staples actually did it. He eventually kind of, but we got about 399 on the SPY here. Tesla is dipping down, kind of dragging the market down a little bit now. Bruce is huge, bro. Bruce is big, I don't have a recent picture of him, but he's big, man. I'm pretty confident Bruce is a working dog as well. I'm pretty confident he is. There's just differences between Rosie and Bruce. Rosie, super sweet, but calm. Like very calm, not a ton of energy. Great family dog. Doesn't listen as well, though, so is a little bit less food and just generally motivated as a whole. And so, yeah, I mean, again, kind of some obvious differences between Bruce and Rosie. Rosie, really sweet, great family dog. Bruce, super food motivated, much easier to train, but way more energetic. Gets a lot more, not aggressive, but just gets a lot more excited in in an easier way. Like I bought a Nerf shooter that shoots tennis balls for Bruce to chase, and when I load it, and he gets super excited about it. He sometimes jumps up and bites the Nerf thing, and so I'm pretty sure Bruce comes from some type of working line, but I'm not 100% sure. But he acts that way for sure. They're shepherds. Yeah, they're German shepherds. He did one with. All right, guys. So we're going to do the Barr testimony today. We're going to stream the Barr testimony. We also have pending home sales at 10. All right, so yeah, Bill Perkins said 20 to 1, 10% body fat in 14 months, 50K to make 1 million. Bro, somebody needs to get me in touch with Bill Perkins, bro. I'll make these bets all day with you, sir. I mean, I'm not Sean Deep, but two former Credit Suisse bankers have come forward to say the bank helped some people dodge taxes for years. Yeah, so SPY back up to almost 399s right now. Matt Kors, I'm gonna go ahead and ban you because you're obviously fishing. And again, man, I can tell from a few different things and how you talk. Um, Listen, man, you seem genuinely unhealthily obsessed with this channel, and I feel bad for you, man. It's one of those things where you're like, you got to move on with your life, brother. Like making a bunch of fake usernames. Like I'm never gonna allow you to work or be close to the channel in any way whatsoever. I'll always be able to identify it's you. Regardless of that, I'm not letting anybody close to the channel anyway, man. But again, some genuine advice to you, Matt, or whoever you are. Fishing is what you were before. Is like, listen, man, it's not healthy to be this obsessed with anything, brother. You know, like messaging my mods and like trying to talk smack. Like, you think my mods aren't gonna tell me, man? Like, it's just unhealthy, dude. And you can claim it's not you. You could claim, but it's just unhealthy, brother. Like, get some help, man. I'm serious, dude. I'm genuinely unhealthy. It's a little bit unnerving, you know, to be honest, man. But like, no matter how much you try, it ain't never gonna work, man. Just kind of, please move on with your life. You know, it's starting to get a little bit, like I said, I'm starting to feel bad. You know. So, you know, I wish you the best. But like, find another channel that wants you there, man. Because we don't want you here, dude. I'm not gonna say how I know it's you, but come on now, man. Hey, what's up, Ren? Earnings, yeah, we don't have really any big earnings. The next big earnings report is gonna be the next big report. Like, we've got BlackBerry coming up. So BB is actually tomorrow. So we could cover a BB. I don't know if BB is gonna have a big enough audience. Do y'all think BB is gonna be a large enough? I think BB is gonna have a large enough audience, but I'm considering it. I don't know yet. Yeah, FRC falling down when the market is moving up. He's not really a scammer. He's just obsessed, John. And again, like, maybe he gets by. Like, I'm sure he's probably going to create another account and just kind of talk, and that's fine, man. But like, again, it just seems unhealthy. It seems unhealthy to obsess that much about anything, you know. In the end, like, if they spent half the time they spent obsessing, and again, I think it's, you know, if they spent half the time they did it obsessing over this channel and others on improving themselves, like, they could do a lot of stuff, but instead, that's what they're choosing. Like I said, I pity them, to be honest. But to be honest, I kind of worry, you know, because it's kind of just off. Why is Bitcoin going up? I'm not sure, man. I think the whole market is just going up, you know. So I think the whole market is going up. I think the SPY is. I'm still trying to figure out the exact reason the SPY is gapping up as much as it is. The only guess I have here is that Barr said some optimistic things regarding banking. So that's potentially why. SoFi, I really don't know, man. SoFi is one of those companies that I'm not super confident in, to be honest. I'm just not super confident in those. All right, guys. So yeah, I mean, AMC is still kind of straddling the previous closing price. Tesla at 192s, SPY at 399s. Um, Microsoft breaks 281 today. It's game over. Yeah, I don't know. Microsoft's still a little bit too high up for my taste lately. And again, I maybe missed out on some buy opportunities, but again, just a little bit too high up there for my taste, I think. Yeah, SoFi is just it's a mid cap that I'm just not incredibly confident in. I'm not saying it's going to fail. It's just not safe enough for me to invest in it, I think. Maybe we filled the gap. Certainly possible. I mean, tomorrow we got GDP data. So yeah, I mean, my YouTube is going to be hard to crack if they're trying to crack into it. Number one is like, I'm not going to be specific about why it's going to be hard, but it's just going to be hard for them to do it. Estimated that I make $69 a month from YouTube. Wildly wrong. Like I said, overall, the channel as a whole makes hundreds of thousands for sure. So I mean, whoever that data is getting us wrong. All right, Tesla at 192s here. AMC dipping down under that previous closing price is now at 511s here. Lucid. I mean, I think Lucid is just jumping on the trend of laying people off and having that positively affect the company. But man, Lucid has had some big drops all the way down to 750s. You a millionaire, bro? Depends on your text. It depends on what you're doing. In terms of assets, maybe. Liquid? No, not really. So again, easing banking fears, causing the markets to bounce up is what most people are thinking. AMC pull it back down to 505s right now. 505s for AMC. All right, guys. So you can see the 200 EMA. We've been kind of straddling back and forth over and under that level for a minute now. I mean, you can get paid some. I'm looking at your channel now, Carbon. I'm a kind of, I like cars. I was never really an ATV rider. I like that low rider though, whatever that is with the extended. What is that, man? R1 Raptor. That thing's dope, dude. But yeah, I'm more of a car head, not a motorcycle head. But it's all good. I like motors, you know. I grew up in the Fast and Furious age where we had like JDM, and like I had like an old Honda H22 Honda Prelude 97 5-speed. It was fun. But yeah, I mean, it looks like I'll give you some advice for your channel, and again, I'll give you some advice because it has nothing to do with my channel, and that's the only, is that shorts. You can let your channel grow into something big, man. Um, Shorts look like the right path, and so you could probably start creating just shorts of you riding unique and different motorcycles. Like if I were you, I would go test drive all these unique and different motorcycles and then create shorts based around them, and then let your channel grow to a point where it should start producing income for you if you continue to do that. If you spend your time only doing that, not only doing that, but if you spend a lot of your time doing that, where you went out and you tried out different unique motorcycles and vehicles, and then you made shorts and you optimized the keywords for those shorts based around that specific thing, um, yeah, your channel could grow fast. Into like there's a good niche too of channels where I wouldn't make it only about carbon fiber. I would make it just about riding in general. Carbon fiber is too small of a niche for you to really get like a huge following from. But again, you could. I would just do it a riding channel as a whole, motorcycles, ATVs, stuff like that, and just find unique ones, ride them around. Even if they're not unique, just create shorts about riding them, and people will watch them. Oh, dude, I love my Prelude, man. My Prelude was fun. I've had 7 H22 Preludes. Hey, nice, man. Yeah, those things were fun, bro. They were quick. VTEC kicked in at like 3,500, if I remember correctly. It was fun, man. I love that car. Yeah, it's the 100K trophy. Never had a CRX. CRXs can be incredibly quick though, just because they're so light. Um, Stephen Goldstein saying, quote, most trading failures are the result of deep issues and aren't fixable at the surface level. Until you get in touch with your inner game and understand what's happening at the deeper level within you, you're not going to resolve the symptoms. Oh, yeah. Speaking of that, dude, we made a bunch of money yesterday. We ended up losing a bunch of money and had to take a swing for, the account, which I'm not really happy about. But we ended up kind of stopping ourselves, reevaluating, taking calculated risks. Like if you remember, my plan in this account was always to build up a couple $1,000s in profit and then take a swing. And so we tried that yesterday, and initially it turned out very poorly. We ended up being down taking that swing, but we ended the day up about 2,000, about 1,900 on Top Step. So we ended up doing great at the end of it. We had about a 2-to-1 win-loss ratio. And so not too shabby, man. I'll take it. But you can see we had a little bit of a drawdown ahead of time. But again, the goal was to take, I think I bought the NQ, but it moved a lot faster than I thought it would. I do. I still have to take the trash out. My bad, guys. My fault. CRXs are dope, dude. I like CRXs. But yeah, so we're watching the market here. I mean, of course it's a business, man. I'm not spending, 4+ hours a day out of the kindness of my heart. That's not a reasonable expectation of me, but doesn't mean that again, people get weird, but the reality of it is, of course it's a business, man. And we do well here. It's all about having reasonable expectations for me here. Yeah, we're going to have sponsors. Yeah, we're going to subsidize the channel. Anybody else in my shoes would as well. The thing, though, is we only take sponsors from things that we believe are truly going to help people, as well as I try to tell people the truth as much as I can, because that's something that I think is severely lacking in the trading niche of YouTube. It's just the truth. Right, you got too many people trying to sell courses to other people, and so they're kind of fudging their numbers. Like when you sell courses to somebody, you can't be honest about losses sometimes, and so they end up fudging their numbers and kind of misleading people into thinking that they're more profitable than they are, just to sell them a course. And my big thing is to never be like that. And so I'd rather just not sell a course, not sell some type of content subscription, and just kind of be honest and real with people about everything I can. And sometimes that rubs people the wrong way, but I guess the point I'm trying to make is yeah, we make money doing this, but we also help people for sure. And again, that rubs people the wrong way sometimes. Our growth has been crazy good over the last couple years, and I think that we had a lot of haters that think about it this way, right? If you get banned and you're a hater, it might hurt to watch me grow, right? Like watching me get better and better and larger on YouTube, that probably hurts. It kind of rubs people the wrong way, I guess. And maybe I do poorly with engaging with those people, but channel really is a blessing, and I think it helps traders. The whole point is to help people, man. And again, sometimes the truth hurts. Sometimes the truth is not easy to hear, and in that regard, sometimes people dislike me because of that. But I really do try to be as honest as I can about how I really feel, even if it is bad for the channel. I try to just be real about it. Hey, thank you, Michael. Yeah, CRXs are dope. They're just really light. Oh, it's the Donald Duck song, man. Who knew this thing was even still alive? I certainly didn't. All right, market's really struggling right now, just kind of slow. Yeah, for sure. Hey, thank you, Grape. I appreciate it, man. Do you think Bitcoin is in a bull trap? So also post on Twitter. I don't know, maybe. Yeah, definitely top 3. Taking the trash out ever in the world right now. Did SVB? What's the symbol for SVB? Stock money. I heard it reopened, but I don't remember the symbol. I know SIVB is still not open. What's the new symbol of it? $92 GSR. 92 Integrity GSR. Blew my first motor. B17. Turned it into a 2. Hey, nice, man. Mofos hate you if you don't agree with everything they say. Yeah. Yeah, so we do have the Barr speech today, and that'll be really interesting too to see what happens. All right, guys, market is kind of choppy right now too. I mean, we're going to get ready to trade. We got about 40 minutes until the market opens, but AMC still dumping down a little bit now. Bear market. Do y'all think the market goes green in 2023? I think is a really interesting question. Do you think the market turns green? I think it could, but do you think it will? All right, guys. SPY back up to 398.80. It's basically been like, look how choppy this has been. The market, the market. By the time I looked at it this morning, it essentially just gapped up super strong. But here's the trend. The SPY's been in for minutes and minutes now, and I'm just kind of waiting to see if we break out of this trend. I'm trying to be as patient as I can, but you know, I'm just waiting. Hopefully, we do break. But let's see if we can pop over 399. I think is the level. 399 is the spot. There's 399. Let's see if we hit the VWAP here. We will take some trades pretty soon. And we are going to cover the Barr testimony here. Let me find this. When is the Barr testimony here, though? Let me see. Schedule. Okay, yeah, it's going to be at 10 a.m. All right, so we have Barr. All right, so yeah, Barr is speaking at 10. It's the federal regulator's response to wreaking banking failures. Look at Tesla rip up SPY over 399. AMC still dumping down. But look at Tesla. Although let's see if Tesla could fight to hit 100 today. The Barr is going to be speaking. House Financial Services Committee. All right, so that's going to be at 10 a.m. in about an hour. And again, we're going to cover that live here fully as it happens. So this is going to be on the House Financial Services Committee. And remember, tomorrow we got some stuff coming out too with regards to GDP data. So yeah, what this is called is the Federal Reserve regulators' response to recent bank failures. Let me look at the FOMC calendar. But yeah, SPY still over 399. I'm a little bit tempted to buy this dip, but I guess I'm just gonna chill and wait. Services Committee. I think you're right until you got to spell committee. Then it's just kind of like, whoa. All right, SPY still pumping up at 399.11s here. Tesla at 192.40s. All right, we also have pending home sales data at 10 o'clock. Mullen stays below 10 for 10 straight trading days. I think it'll get delisted. Maybe. I'm not really in anything super heavy. I'm holding a couple over like longer term swing trades that I've been in. MVIS, man, it's been so long since I heard that stock. All right, guys, market's trying to pop up a little bit. Again, we had a pretty good day on Top Step yesterday. And if you want to day trade here, look, you can see our profit graph. Pretty solid here, pretty solid. That was our profit yesterday. If we look at this week so far, been a crazy week, but we are up this week about $1,900 or so with some kind of crazy volatility. And again, if you want to try to day trade with me here, I'm day trading on a funded account program called Top Step. They are a sponsor of mine. But what they do is they give you a demo and they test your profitability. And if you could pass their profitability test, then they legitimately fund you between $50,000 all the way up to $150,000 with a 90% split. So you're keeping 90% of your profits if you can get funded. If you can't get funded, if you lose the challenge, which I think is going to be most people, then you're still going to be losing less than you would if you put the money up yourself. And so it's the best of both worlds. It's a perfect middle ground of pressure to where you have some pressure, you don't have the full extent of risking thousands, and it's a great way to learn how to trade. And the best thing is that there's no PDT rule in futures. A lot of people don't understand that the futures is the single easiest way to get around the PDT rule. You can use a margin account in futures. There's no PDT restrictions. You can day trade and short futures without the PDT rule. And Top Step funds traders in that regard. And so you can trade the SPY, which you can see is ripping up right now at $3.99. Looks exactly like Tesla. And so it's the easiest way to day trade with no PDT rule. And if you want to learn more information and check them out, again, here is the link. Great way to help support the channel here. You also found the link in the Discord as well if you're interested in checking that out too. Waiting for... All right, so there's 8. I'm going to put the futures market up. We were waiting for the Fed speech to start. We also have pending home sales at 10. Drop at 10. So we do have pending home sales dropping at 10 o'clock. Yeah, Lulu had good earnings yesterday, I think. And as I've said, man, Lulu's strong short term. Long term, I just don't trust it. Like, I would invest in Lulu, but it's a fashion company. And to be fair, it has a chance of succeeding long term, too. It's not like it's like a guaranteed fail long term. But again, putting my money and sitting in that thing for 5+ years just seems risky to me because it's fashion. And fashion usually doesn't stay relevant that long. But of course, like I said, I've got a wife and a daughter. They love Lululemon. You know, I have some Lululemon stuff, believe it or not. And so I understand, like, Lulu is raking in money right now. But that's not the risk in Lulu. I think the risk Lulu is long-term holding. SPY pushing up here. Will we break 400 today? Which platform should I choose on Top Step? I use Quant Tower is the platform I use. So this is Quant Tower here. It acts a lot like TOS. Again, we're going to get ready to trade. But this is Quant Tower right here. Market had a nice rip. Huge gap up today. And you can see this is the S&P 500. So this is just the S&P 500. Let me edit this to where... There we go. Yeah, and again, we are going to stream the Barr testimony today. Starts at 10 o'clock. Bitcoin, yeah, Bitcoin has been flying up right now. Up to 28.5K, which is great news for Bitcoin. I'm happy for it. Will the market bounce today, guys? Ugh. I'm supposed to put art? No. So the base package is like 130 something a month on Top Step. And again, that the edge is simple. Okay, the edge is that with these funded account programs is that if you're good enough and can pass them, you'll get funding. If you're not good enough and you don't pass them, which I think is going to be a lot of people, then you're going to lose less than you would have if you put the money up yourself. And so if you get funded, you still keep a large majority of the profits. So the reward is the same. You're still getting 90% of your profit once you're funded if you pass the testing. If you don't pass it, you probably would have lost more on a regular account anyway. And so it's a genuinely useful and unique thing to test your skill, you know. Again, if you want to check it out, you can find the link in the description. I'm not going to post the link again, but if you want to check it out, links in the description. Again, I'm definitely biased, though. They're a sponsor of mine. But again, I think they are genuinely useful. All right, guys. Still popping up. Micro E Mini at over 4K, up to almost 4,040 here. I don't know if any stocks to buy or sell, man. I always try not to tell people whether to buy or sell stocks. It's just not really what I do. I don't think it's good for traders in that way. I don't think it's necessarily helpful for traders in that way. I think it just causes problems. And I think that traders should understand that nobody knows for sure. I think we already got too many 18-year-olds with braces trying to pretend to be stock market experts and to pretend basically a bunch of Jordan Belfort clones. And again, I talked about it earlier, but the irony is that like Leonardo DiCaprio is all like, yeah, Jordan Belfort's a terrible guy. You know, he's the worst type of person in the world. But like you creating that movie created a bunch of Jordan Belfort clones and also made Belfort way more famous than he was beforehand. And now he's out here on YouTube being a mentor and stuff. So, I mean, if you genuinely think Belfort's a bad dude, you creating that movie was counterproductive, you know? And because again, I mean, you could look at The Wolf of Wall Street and say, oh, well, it's a lesson on greed and why greed is bad. And that's fine. But I promise you, a lot of the people that watch it are just looking up to that stuff. And it's glamorizing that stuff. And so I think it's a little ironic. The consequence of that movie turned into be what it was. And now you got a bunch of, again, and the even more ironic part that we talked about earlier is like people are acting like they're Jordan Belfort, yet they're buying the crap that Jordan Belfort sold to naive investors. What did Jordan Belfort sell to naive investors? Terrible penny stocks. What are a bunch of Jordan Belfort clones doing? Buying terrible penny stocks. Again, the irony is something that is just kind of, I can't help but talk about. Oh yeah, this channel's definitely for entertainment purposes. Top 3 for sure. Yeah, we're gonna stream it. Market Robbie, that's why we watched it. I mean, hey, can't argue there. Steve Madden actually did some sketchy stuff back then too, bro. So Steve knew. Steve got Jordan to pump up the shares and then unloaded on him, tanking the stock. Baby, Steve basically did a pump and dump in the 80s with Steve Madden. Who knows what Steve Madden could have been if they didn't pump and dump it like that. I mean, they were still wildly successful, but I think there's an argument for Steve Madden being even more successful if they didn't do that. What's the new symbol of Signature Bank, guys? I'm still looking for it. It's an OTC stock. What's the new symbol? Because anybody tell me the new symbol? Lamar Jackson team predictions. I hope he goes to the Saints, bro. But I'm a Saints fan, so I'm just hoping that for my own. SIVBQ. Yeah, man. Wow. Silicon Valley Bank, 38 cents a share right now. All right, markets push it up. You got the high of the day up here. What's your favorite place to eat in Louisiana? I don't know, man. There's a lot of good places. It varies. I like Sammy's in Baton Rouge. Good crawfish, you know. There's a lot of places. Syrops, Albashes. Yeah, a bunch of places. Best Greek, Lebanese, Middle Eastern food is Syrops and Albashes in Baton Rouge if you're ever there. New Orleans has got some really good food. All right, guys. I looking good here, man. Ahead of the bar testimony. Again, we'll see if it ends up helping the market or helping the market or hurting it, but The market volume kicks back up tomorrow and Friday because we have GDP data and jobless claims tomorrow. So my daughter listened to Rage Against the Machine yesterday and she called it emo. I was like, what? Emo? Rage Against the Machine? I mean, I know it's angry, but is it really emo? All right, guys. All right, so we got the stream ready here. We're gonna cover the open, but where'd it go? There it is. All right. Market, let's see if we break highs here. I mean, the SPY has got a chance to break 400 today. The SPY is right around 399.50 or so, right underneath it. AMC dipping down finally here. Again, we're going to cover the testimony and all that stuff. Yeah. Yeah, let her listen to Killing in the Name. And I was like, look, this isn't emo. I was like, emo's whiny. You know, Rage Against the Machine is angry, but it's not whiny, you know. Do you use trade copiers? No. No, I didn't mute myself. Y'all can hear me, right? Right, for sure, Alberto. That's what I'm saying, man. I was like, I had to correct her. I was like, look, you don't know what emo is. If you're saying this is emo, you know. Emo is like my dad didn't love me. Rage Against the Machine is like F you. You know what I mean? There's just a huge difference there. All right, cool. As long as y'all can hear me. All right, guys. Market's pushing up, getting ready to test those highs at the day levels again here. Let's see if it actually does. GDP data. GDP data is tomorrow. Expectations for GDP are for 2.7%. And I'm not sure. Look at the market rip. So market just ripped up over the previous high of the day. SPY is pretty close to 400 now at 399.70s here. 399.70s on the market. Flying up right now. Yeah. Pumping in the name of. All right, almost to 400. Yeah, I mean, again, like people get mad at me for being not really anti-bearish, but for like people get weird with me when they come here and they're like, "Hey, the market's gonna crash now, sell, do it now," and then the market ends up ripping up huge levels, you know. And then I'm like, well, bears. I'm not gonna say I told you so, but I definitely told you so. And again, it doesn't mean the market's not gonna fall back down. It doesn't mean that. All it means, though, is that a crash isn't as easy to predict as a lot of the bears think it is. Okay, a lot of the bears have been watching The Big Short. They've been watching they've been watching Michael Burry, and I get it. But a lot of them have been watching just political news as well, right? Regardless of any of that stuff, crashes are very difficult to predict. You know, the government's going to do everything they can to stop it from happening. And again, we'll see what happens today. Banking optimism is making the markets bounce. Bitcoin is back up too, and it doesn't mean we're not going to come back down. Again, we did have the inverted yield curve that can sometimes precede a recession. Not always, though. It's not like every time we get an inverted yield curve, a recession is around the corner. It's not every time. All right. It generally, though, when we have a recession, it's preceded by an inverted yield curve. So, but it's not every time. And so the point here is that just because the yield curve is inverted does not necessarily mean a crash is completely necessary. It also more so signals a recession about a year later. And so the time is off as well. And so we'll see what happens. I'm not saying we don't crash. I think a recession is more likely than just a flat out crash. But again, the market obviously is not showing that right now. SPY up to 399.75s. Yeah, it's kind of one of those things that they're emotional if they get mad at me for being right. You know, that's when you really know they're emotional, is when they get mad at me. When I'm right, I'm clearly right. I've obviously been right over the last 3 months since I've been saying this, and yet they're getting mad at me. Genuine emotion. But again, we'll see what happens. I think we might pull back ahead of the opening bell today, but who knows, man? I really don't. All right, we're going to get ready here. SPY consolidating. Let's see if we hit 400. We could. I hope we do. All right, so again, we are going to stream the Barr testimony on bank failures at 10. In about 35, 40 minutes, we are going to stream that. Again, we'll stream the whole thing. We are waiting and ready. Let me see if we have this. It's consolidating after the bounce. Mariners about to win the AL East. Maybe. I'm not emo, but my trading is. You need to stop emoing your trading and start raging against the candlesticks. Too extended, man. Yeah, I mean, I tend to think we're probably a little bit too extended here on the upside. I'm not buying up anything. I've been pretty flat on everything because I just don't think that I'm not confident enough in this market, to be honest. But maybe we do some stuff. I don't know. All right, market pull it back a little bit again. I think we're a little bit too extended, but I also think with the Barr testimony today, I think there's a chance that like we don't pull back too. Of course. So I think there's a chance that because of the bank testimony today, if they continue to say optimistic and positive things, there is a chance that we just kind of, continue going up. Not a great chance, but there is a chance. BARR. Yeah, that's what I have it as. BARR, bar. Am I saying it right? Maybe I'm not. Is it bear? I don't know. Now we got to know. Hold on. I'm muting the music for a second. Make sure I'm pronouncing this right. Yeah, bar. BARR. I think I'm saying it right. Chat, let me know. Definitely top 3 bar pronouncers in the world right now for sure. Bear, then bar. Maybe it's my southern accent, I guess. Yeah, Rage Against the Red Candles. Rage Against the Candlesticks. John from Beginner Trading. Top 3 mixtapes in the world. Over 1 billion copies sold. Michael Scott. Rage Against the Candlesticks. SPY bounced it up a little bit today. We'll see if it continues. Is it Burr, like Gucci Mane? Like So Icy Entertainment? When do you think real estate will head back up? I don't know, man. My real estate license is inactive as we speak. Apparently, I got to take some type of continuing education that I'm not necessarily happy about. I got to take... I'll probably finish the education today. They say it's going to take 18 hours. Bro, come on now. If it's multiple choice, I don't need 18 hours here. All right, guys. We got 3 minutes, 2.5, really about 2. All right, guys. Market's trying to push up. We'll see if it does. Again, I think what's going to matter is the Barr testimony. I think that's what helped it. Which is better, real estate or stocks? They're both similar returns. Over the long run, stocks are generally more consistent. But in terms of net worth building, real estate is more beneficial. Because the reason real estate is more beneficial is because you can buy a home, refinance that home, buy another one, refinance the other one, buy another one, refinance it, and you can kind of slowly grow and expand your real estate empire that way. Stocks, you can't really do that. I mean, you can use compound interest, which I guess is a similar thing. They're both ultimately used to hedge inflation because real estate and stocks generally keep up with inflation long term. So there's pros and cons. Real estate is going to be more expensive to own, if that makes sense. So like you're going to have to put more money in upkeep with regards to real estate, where stocks, you just kind of put your money in and you let it sit. Stocks, you have a bigger short-term crash potential versus real estate. And so there's pros and cons. Is it better to stay single in your grind? Well, it depends on who you marry or who you're with. Market's about to hit 400. Look at the SPY breaking highs right now at the opening bell. Right at 399.99 right now. So, again, we got about 20 seconds until the opening bell. Yeah, so 10 seconds, guys. But yeah, it varies, to be honest, depending on what you're doing. SPY right at 399.90s. Let's see if we break 400. AMC pushing up as well. All right, here's the opening bell. All right, so there's the open, getting a little bit of a dump into that opening bell. All right, big pullback here. We will look to short the market. I think we tapped 400. We never actually broke it though. So we tapped it. So again, we'll see if we get a pullback here into it or what happens. It's SIVBQ, I believe, is the new symbol for the OTC SVB. I think it's SIVBQ, but I'm not 100% sure, to be honest. I get a little pullback here. I'm not going to take any trades in the first few minutes. AMC falling back down to $5. Hey, y'all do me a favor. Remind me before the Barr testimony to switch out my headphones. Before the testimony to switch out my headphones, please. Somebody remind me that. So before 10 a.m., maybe 5 minutes early, remind me to switch out my headphones. All right, market's starting to fall. Again, let's see if we bounce back or what happens. We're right around the volume weighted average price on the SPY here, right around that spot. Hey, thank you, Justin. All right, guys, market's starting to dip. Again, SPY is what testing the volume weighted average price right around 399.50 here. Somebody told me on TOS there was a way that you could. Oh, there it was. Yeah, on TOS you can put your scroller on the price axis, hold control, and then move the price axis up and down, which is very useful. But yeah, market is right at that level here. Again, we'll see if it holds or what. Again, I think we're extended on the upside, so I think the downward direction is a little bit more in play today, I think, but who knows for sure. But I've been saying this all morning. I think we're just extended. I'm not buying anything right now. But we're bouncing off the VWAP here, so we'll see if that's a mistake or not. I'm going to buy one contract here. Maybe add more, maybe not. If we get a larger breakdown, it'll be easier. But I'm going to add one more there. Fix my average a little bit. 2 contracts here. See if we get a flush back down. But we'll cut it pretty quickly too here. I also need to be sure to switch my sizing out after I exit this trade. If I lose on this trade, one of the mistakes I've been making lately is adding size accidentally. So leaving 2 or 3 contracts up on the quantity, which ultimately has been bad because it's made it so that I accidentally take larger positions than I really want. Testing the bottom again, very rangy right now. I'm going to put a timer up. So we broke down a little bit. We're still pretty flat here, getting a quick bounce back. I want to give a chance to break down. How much time we got? We got about 25 minutes. All right, so getting a little flush, slightly green here. I like the up wick. That's usually a good sign. All right, so here is the timer. Small range on the day. Yeah, I don't know if First Republic's going to get bailed out or not. I'm really not sure there. If we break over this level, I'll probably cut it. I just don't think there's any benefit of sitting in it over that. I think with us being so close to 400, which is a psychological level, I think if we start to reverse and head back up, there's a chance we squeeze up big, and I don't want to get necessarily caught in that. Market is right around the VWAP. Very neutral day. I think a lot of people are maybe waiting on the Barr testimony. I'm going to cut this. It might reject back down and continue, but I just don't know if there's a point in sitting in this waiting. It's just too choppy. I could take a longer term position, but I think it just makes more sense to cut it and regroup and wait. Take the small L. $10. Everything's starting to reverse. There's a little bit of a rebound. Yeah, I mean, as a real estate agent, I've already taken legal update 1 and 2. And so I don't know if I have to take it again or like what the deal is. All right, guys. So again, very slow day. Everybody might be waiting for the Barr stuff to happen. We do have pending home sales in about 23 minutes too that we'll cover for sure. Next week's a much busier week. We've got ISM manufacturing and construction spending on Monday. Tuesday, we got factory orders and JOLTS job report. Wednesday, we got ADP non-farm employment change, trade balance, and ISM. Thursday, we got jobless claims. Friday, we have non-farm payroll numbers and unemployment Friday, which is odd because the market's closed Friday. Next Friday, that is. Not the movie. U-shaped breakout pattern. AMC starting to rip back up, potentially starting to move towards the VWAP here. So it's about the banking crisis that happened, Alberto. So what Barr is going to be speaking on is the banking crisis that happened. So it's on banking. So it's called Remarks for on the Community Reinvestment Act. Oh, wait, has the speech already happened? No. Okay. This is going to be testimony today. Yeah, so all right, market is very sideways and neutral leading into this. Music just stopped. Yeah, I think my headphones are acting kind of suspect anyway. Make sure these headphones are charged enough. All right, I'm just going to switch my headphones out now because I can. You can see the timer in the top left. All right, market started to dump down. We will start to short a little bit more if we can, but it's so sideways at this point. I got to wait for a break under VWAP. AMC is actually starting to rip back up a little bit too. Looking at some other stuff here, you can see Tesla having a very strong day. The SPY sideways. Look at AMC start to rip. It's back over 516s here. The market is still pretty neutral though. Barr speaks at 10 o'clock, Lenny, so we're waiting for that Barr speech. It's in 19 minutes. FRC is ripping right now. FRC, yeah, FRC is flying back up. It's kind of influencing the market here, but man, look how sideways the market is. All right, market's trying to break down. All right, we will start to short the market too if it looks good enough here. I forgot to switch it back like I wanted. There's 4 contracts. We'll see if the breakdown happens, but we'll cut it quickly if it doesn't. I think 4 contracts is kind of like a sweet spot with regards to like profit and loss anyway. But man, if we bounce here, the market is just really confirming choppy trends. AMC actually went up and broke green levels here. Yeah, I'm going to cut this. Too much of a fake out. We're not really down that much. We're down like $40 on the day. So it could be worse, but the market might also be waiting for Barr's speech as well. It's really slow. Yeah, you can see the market range right here. Freaking them out. Yeah, I mean, I think where'd it go? I think the market's just slow. A lot of people are nervous, I'm sure. All right, market's right back up. Because we got faked out enough, I think I'm just gonna chill for now. We do have the Barr speech coming up. I'm just kind of sitting back waiting. Is SQ printing? Yep. I told you guys, man. I mean, listen. I try to be real about strategies. I think one of the biggest things that I see people do wrong is like they're universally one direction, not the band. They're universally one direction, right? So bears who think that the market might go into a recession in the future are just automatically bearish on every mid and large cap stock, short term, long term, it doesn't matter. That's a flaw. Like that's flawed thinking. You know, same thing with like short report comes out for SQ. And so SQ drops 20% from that short report. 20%. Who in their right mind is going to try to continue to short SQ after that? Do y'all really think it's going to drop 50% plus? Like, who in their right mind is going to do that? Again, greed is all it really is. And again, I literally, as I was buying SQ after that dip at like the high 50s, it's at 66 right now. Look at this big rejection here. Wow, look at that dump. So again, very rangy market right now. I'm not jumping in it yet. But it's just obvious, man. It's like, okay, SQ, fairly healthy company. Cash App is you know, one of Jack Dorsey's companies, I'm pretty sure. Cash App is what SQ is. Dropping 20+% in 15 minutes. Y'all are gonna tell me there's not about value in buying that dip? Again, people just don't see it enough. They don't understand. But and honestly, it feels good because it's like I had a lot of doubters when I bought it, and I kind of slowly showing people, hey, look, I kind of know what I'm talking about, man. Like the people in the chat who are just trying to talk smack are usually people who are losing traders. Like a lot of them are pretending to be profitable when they're really not. They're just kind of losing traders trying to act cool. But like I know what I'm talking about with swing trading. I'm very green on my swing trades. I've made a bunch of money on swing trades this year, and I've been very accurate with them. You know, and of course I can't guarantee anything. I have no idea what anything's going to do. I don't know if something's going to go up, down, or sideways. Any individual trade isolated, I have no idea what it's going to do. But I understand what tends to work lately with regards to swing trading. I understand emotion, I think is what helps. Like I understand when something pulls back very, very strong, even if it pulls back and then bounces up a decent percentage and then continues down, you're generally going to get a bounce as long as it's not a penny stock. Penny stocks, this is completely irrelevant because penny stocks will just keep on going down. But mid caps, large caps, any well-known company, Amazon, Apple, Disney, SQ, whatever you want to say, that tends to be very, very likely probability. All right, so we're very sideways in this range. I don't know. Disney's a little bit too high up for me right now, personally. It's at 96, 97 bucks. I like Disney at the low 90s. It's at the high 90s right now. It's just a little bit too cheap. I don't mind the bottom right now, though, to be honest. So, like, I don't mind that $90 level for Disney. But I'm not in it right now, to be honest. All right, so we broke the top of that range. So we did break the top of that range. We'll see if it continues. All right, remember, guys, bar testimony at 10 o'clock. Again, I'm day trading on Top Step today. I'm not super confident in any specific direction. I'm going to take one contract here. But if you want to day trade and not take on a lot of risk, yet still have the chance to get funded and keep 90% of your profits, try out Top Step. It's the most legit one in the world. There's a lot of other clones of it that claim to have better, better conditions. But again, getting your money out of them is a different story. Top Step has been around for over a decade. They give you a demo. They test your skill. If you can pass their testing, they fund you legitimately. Been around for over a decade, pay out millions every year. They fund thousands of traders a year. It's just the easiest way to get exposure to day trading stocks without needing 25K. You can day trade the S&P 500. You could also trade oil, gas, which move with these economic releases that we cover. Just very useful for traders, inherently useful, saves new traders money. And I think most new traders are going to lose this. But if you're good enough and you want to test yourself, it's a great way to test yourself without losing thousands of dollars. But again, they are a sponsor of mine. I'm certainly biased in their favor. But if you want to check them out, I'll post the link here. A little bit green in this trade. But again, I'm not really trading very big today. I'm going to probably wait until the Barr speech and then maybe try to have some pairs trades based off of what he says is my plan so far. Barr speech is about 10 minutes. Oof, nasty dump. Good thing, yeah, there's some big orders getting thrown around here on the S&P 500. So I'm probably just going to sit back and wait until this starts. Snap. Yeah, snap. I mean, to put it into perspective, what a choppy day means in the market, guys. What a choppy day like this means is that some blue chips are moving up and some blue chips are moving down right now. Should be a little self-evident, but like, let's see the ones that are moving up. Amazon moving up. Tesla slightly moving up. Apple sideways. Microsoft testing highs. Disney sideways. AMD testing highs. MU testing highs, looking really strong for MU. Google breaking down. So Google is one of the blue chips that is falling today. Walmart's not really moving much. Yeah, you saw that huge red candle. It's not, I wouldn't call it crazy. I just think it's sideways, but it's a big range, volatile, like violent move sideways. Yeah, NASDAQ moving higher. So NASDAQ's pumping. Yeah, small caps don't really influence the market, though. You know, like small caps aren't going to influence the S&P. You think Barr is going to talk the market down? It's possible he does. I don't really know. We'll see. You better raise the bar. Yeah, I'm sure there's a lot of puns here to be had. You know. All right, guys, we got 7 minutes. Y'all, genuinely good luck. I wish you guys luck. I hope you guys make some money. All right, starting to pop up a little bit though. Look at the micro E-mini up there. Starting to test highs. Again, I'm going to wait for the bar speech and then probably try to Paris trade the SPY. Yeah, GDP tomorrow. Jobless claims tomorrow. PCE Friday. And the Fed actually uses PCE a little bit more than maybe like CPI. So like Jerome Powell and the Fed actually like PCE, which is the personal consumption expenditure data. They actually like that a little bit more. So we are waiting for this. All right, market sideways. All right, so we are going to get this ready here. And I can maybe switch this around so we can watch the E-mini. And then maybe do another one here so we can watch like the NASDAQ. Or maybe like pull up a crypto chart so we can watch like Bitcoin or something like this. Right, so there's the E-mini at the top. I'll put Bitcoin up here maybe. Let's see what he says. All right, so there's Tesla with a big reversal here. Let's watch Tesla here. That might influence stuff too. But how's this, guys? It's pretty good, huh? Maybe make this a little bit higher, like this. And go like that, and then maybe go like that. And then I will get this out the way. We got the timer right here while we're waiting.
4 minutes. And then I'll also make myself a little bit smaller here. I can make myself like a little bitty. Pending home sales at 10 as well. So I'll be ready for that too. There we go. Let me know if that's better. But yeah, we do have pending home sales at 10. How about this? Does this work? This would be pretty solid, huh? Brady Bunch style. All right, we'll see how this affects the market. We are ready. This is live. Sound check. Y'all can hear the music, right? I'm just getting everything ready. We also have pending home sales data dropping in about 3 minutes. All right, guys, 2 minutes, or about 3 actually. Well, the market do react positive. I'm going to end this poll and we're going to do another poll about does the market positively or negatively to Barr's testimony. Yesterday, the market reacted pretty positively. All right, there's the poll. Vote on that poll. Let us know. Market is very flat, very sideways leading into this. You can see the SPY in the middle right here. You can see Tesla actually moving up a little bit. Oh no, what have I done? There we go. There we go. I think that's the best way. All right, Tesla back up, SPY back and bouncing back up. Very choppy market. All right, guys, 2 minutes. We also have pending home sales data, which we are going to cover literally as soon as it comes out, as well as the testimony here. So pending home sales data is supposed to drop. I don't think it's going to influence too heavily the market, but it should influence it some. Pending home sales data comes out. Expectations are for minus 2.3%. Minus 2.3%. It drops in less than a minute. Yeah, we're going to put this out so we can find it fast. And yeah, we got this basically completely ready for pending home sales. Again, minus 2.3 expectational for pending home sales. We'll see if we hit that. Minus 2.3%. We are ready for pending home sales data coming out. All right, we'll get the timer out the way. And then here goes pending home sales right now. We'll see how this influences the market. This should be live pretty soon. All right, look at the market rip up. All right, there's pending home sales. Pending home sales came in at 0.8% positive versus minus 2.3% negative. 0.8% positive versus minus 2.3% negative. The SPY just broke the $400 level again, but the market is liking pending home sales. Again, 0.8% positive versus minus 2.3% negative. So more home sales than initially anticipated. So maybe some optimism for the housing market here. We'll put the data up in the chat. There's the chat data right there, pending home sale data. And we're waiting for the speech to start. They're not live yet. We're waiting here. But there's the pending home sale data right here. We're waiting for Barr to speak. He should be live anytime now, waiting for this to start. but 0.8% versus minus 2.3% expected. So you can see the market rip up a little bit on that data. But again, hit that subscribe button. We cover this as soon as it happens every time. If you appreciate it, hit the sub button. Check out the notification bell as well. We appreciate it. Market's moving up on this data, about to hit 400 again. You can see it's right underneath 400. Now, again, we're waiting for this to start here, team. Y'all can hear the music, right? Well, market's interpreting this as positive for whatever reason. Hey, y'all can hear the music, right? I just want to make sure before we start this, the volume is... okay, good. All right, I'm going to turn off the music right now. I'm going to turn that off, and then we're going to put this on full volume here, waiting for it to start. All right, guys. So, again, let me know if you guys think this will be good or bad for the market. So you can see the SPY and the E-mini here starting to pop up here. More pinning means more. Yeah, just turn the music off intentionally. All right, so market's turning back down again. We're waiting for this to start. Usually they're a little bit late, but we got it. Oh, and we're sitting here waiting. Again, check out our sponsor Top Step if you want to day trade some of the volatility here. The E-mini is the S&P 500, and you can day trade it with no PDT restrictions in futures /ES. Top Step's the most legit futures funded program in the world, and so it's the easiest way to test your skill. If you're good enough, you pass it. You still keep 90% of your profit once you're funded. And once you're funded, you're regulated by the CME. If you don't pass it, you probably would have lost anyway. And so it's only $140 a month. If you use my link, you can check out the link in the description. Great way to get around the PDT rule. It's what you see me trading. I'll probably pairs trade some of this action from this testimony as well. I'll probably pairs trade some of it because I do think Barr's words will influence the market. Let me know if you guys think it will too. But yeah, look at the SPY rip. SPY back over 400 today. Back over 400. Markets are loving this here. Look at the E-mini rip all the way to the top, over 4,000. If you want the website, Ramiz, it's in the description. It's called Top Step is the name of it. Here's the link right here if you want to check it out. Again, they're a sponsor of mine, so I'm certainly biased in their favor, though. So I always try to be honest about that. Yeah, so the music is off. Make sure y'all are live as well. So you want to make sure that when you press the play that you're completely live on stream here. So you want to make sure you are completely live on stream like this. You want to make sure you click this live button next to the play button to make sure you're fully caught up on stream. If not, you might be delayed. So that's where you're fully live is when the live button is red. All right, guys, SPY is moving up over 400 again. They're a little bit late on this hearing, and that's okay. But patience. Waiting. Look at the SPY rip up here, man. Wow. Look at this. The SPY breaking over the top of that range here. Again, we're waiting for it to start. You can kind of see. There we go. I can hear the volume. So they got the volume live. Looks like they have muted it real quick, but yeah, so they turned the sound on, which means they're about to start. Waiting for them to start here, guys. Here we go. I can hear the crowd speaking. Tesla turning around, SPY turning around. We are going to put it in sub-only mode, so if you haven't already, guys, hit that sub button, team. We appreciate it. Hit that sub button, hit the notification bell. We appreciate the growth. Tesla turning around here ahead of this. We can hear the volume. SPY still over 400. Let's see if we actually hold that spot. Sounds like they're getting ready here. And so this is going to be about SVB, about banking, micro E-mini turning here. Look at the micro E-mini turn. Very choppy day though. Look at the, so we pushed up a lot and now we're basically coming back down some short term. If you look at the SPY, for instance, here, still over the VWAP, but testing that level now. Bitcoin still holding pretty steady at 28.5K.
Committee will come to order.
All right, here we go.
Without
Sound
objection,
check.
the chair is authorized to declare
Sound should be
recess
good.
committee at any time. The hearing is entitled "The Federal Regulators' Response to Recent Bank Failures." And without objection, all members will have five legislative days within which to submit extraneous material to the chair for inclusion for the record. I now recognize myself for 4 minutes to give an opening statement. Today, let's put aside the pre-baked narratives that have dominated the political discourse. We're here because the American people deserve answers. Before we draw conclusions on regulation or changes to law, we need to establish the related facts. In the run-up to its failure, Silicon Valley Bank experienced rapid growth, relying on undiversified and deposit base and investments made risky by a high inflation environment. We know the bank was mismanaged. That much is clear. Now we need insight into the decisions and decision-making process of financial regulators related to the second and third largest U.S. bank failures. We need insight into those key days in March when an idiosyncratic bank became a systemic risk, spawning a large-scale financial intervention that's still ongoing. Vice Chair for Supervision Barr, you've been on the job for less than a year. You came to the job well qualified. However, you made time to start a review of climate risks in banking and a review of capital standards for larger banks, with no mention of changes to bank supervision or liquidity provisions, two matters at issue with this bank failure. In fact, I've never heard you say to Congress that you didn't have the tools to do your job. In fairness, though, neither Dodd-Frank nor that technical corrections law, S-2155, dealt with issues presented in March. A digital bank run, the speed and volume of which had never been seen before. This committee would like to understand your thinking in the key hours of that first week in March, where your decisions had a mighty impact. Was there adequate planning for a large-scale bank run? Did the chief supervisor follow the playbook to ensure the bank did not fail? How did the chief supervisor and examiners miss the hole in the bank's balance sheet? These are related questions. Additionally, the committee has no insight into the decision-making or the actions of the FDIC chair on Friday the 10th through Sunday of that week when that systemic risk exception was announced. Again, did the FDIC chair use all the tools at his disposal to resolve the banks that weekend? Was there a viable private sector solution? There are reports that multiple banks were interested and ran the traps internally to purchase Silicon Valley Bank that weekend. You confirmed as much yesterday, Chairman Gruenberg. But as we all know, Silicon Valley Bank was not purchased until late Sunday, March 26th, at an estimated $20 billion in losses to the Deposit Insurance Fund. Why wasn't a potential buyer accepted sooner? Was there an ideological lens that prevented the FDIC from pursuing a private sector solution that could have staved off the uncertainty of the last 2 weeks? We know on Sunday, March 12th, another bank is shuttered and placed into FDIC receivership. And together, this is deemed a systemic risk event. That evening, the Financial Stability Oversight Council meets in executive session. No meeting minutes, no transparency for the public, just an announcement after the fact. That lack of transparency has a negative effect on the public view of the safety of the financial arena. Congress needs visibility into how and why this determination was made by the FDIC, the Fed, the Treasury Secretary, the FSOC chair, and the president. I'll finish with this. We need competent financial supervisors, but Congress can't legislate competence. Today, this committee wants to understand your thinking in those key moments and that decision-making in a moment of stress in our banking system. Thank you for being here and your willingness to give answers to our questions. At least that's the hope. With that, I now recognize the ranking member for 4 minutes.
Good morning. I'd like to thank Chairman McHenry for working with me in a bipartisan way on investigating the failures of Silicon Valley Bank and Signature Bank. Today's hearing is the first of what I expect to be several hearings on this important topic. Chair Euenberg, Vice Chair Barr, and Undersecretary Lang, the collapse of SVB and Signature Bank earlier this month marked the second and third largest bank failures in U.S. history. In fact, SVB customers withdrew a staggering $42 billion in less than a day, making it the largest bank run ever and threatening to snowball into a full-blown banking crisis. But 2023 is not 2008 because of the Dodd-Frank reforms Democrats on this committee passed, as well as the bold and swift response by President Biden. Secretary Yellen and our banking regulators, a crisis was averted and our banking system remains strong. However, these events are a wake-up call. We must uncover how management, regulatory, and supervisory failures contributed to these events and explore solutions to strengthen the safety and soundness of our banks. Small business owners should not be expected to serve as a financial regulator when paying their employees, and community banks and minority depository institutions should not have to pay for the failures of bank mismanagement at SVB or Signature Bank. Since day one, SVB's collapse, committee Democrats have been on the case. In fact, under my leadership as ranking member, we quickly organized several bipartisan briefings with our nation's regulators to better understand what happened, share what we were hearing from constituents, and urge regulators to act. Since then, we've sent letters demanding answers from our regulators. And in response to Biden's call to Congress, I and my colleagues are working on legislation to, for example, enhance clawbacks and other penalties. We also need answers from the CEOs who not only ran these banks into the ground, but enriched themselves. It is also important to know how we got here. Deregulation. Former and disgraced President Trump said he'd do and I'll quote, a big number on Dodd-Frank, and his appointed regulators did just that. At that time, I sounded the alarm on the dangers of weakening capital and liquidity rules for banks like SVB. The light touch cautions from the Fed to SVB management are clearly not what Congress intended for bank supervision. I hope Republicans will join Democrats in strengthening compliance with bank rules and transparency over this process. Before I close, I want to address the extreme mega Republican narrative about the bank failures. Let me be very, very clear. Silicon Valley Bank collapsed because of management failures and possible regulatory weaknesses, not because there was one Black man on the board. We saw the same racist playbook during the 2008 financial crisis when some Republicans blamed the Community Reinvestment Act and loans made to people of color. Rest assured, Democrats will not stand for this blatant racism. With that, Mr. Chair, I yield back the balance of my time.
We'll now recognize the Vice Chair of the full committee, Mr. Hill, for 1 minute.
Thank you, Mr. Chairman. Today, we're confronted with the results after 10 years of too loose monetary policy and recent wildly excessive spending. Some bank management teams have forgotten their prudential obligations to their depositors and their shareholders. And clearly, many customers forgot their own prudence and their own financial responsibility. But as our committee comes together, the chair, the ranking member, and members are concerned about the supervisory failures by the regulators who are supposed to keep a watchful eye. Some lawmakers have been quick to use this crisis to put politics to push their preferred policy outcomes. But that's premature. We need to first understand what happened, when, and why, both leading up to the bank failures as well as the decisions made by your agencies represented in our panel today in response. Only then can we decide the proper path forward. That's why Republicans are conducting a comprehensive review, starting with oversight letters to the Federal Reserve, the San Francisco Fed, the FDIC, the FSOC, the California and New York state regulators. We expect your full cooperation in this matter, and make no mistake, today's hearing is just a first step in that process. I thank the chair for the hearing, and I yield back.
The chair now recognizes the ranking member of the Subcommittee on Financial Institutions and Monetary Policy, Mr. Foster, for 1 minute.
Thank you, Chair McHenry and Ranking Member Waters, for convening at this crucial time, and thank to our esteemed witnesses for being here today. I remain proud of what we did almost 13 years ago with the Dodd-Frank Act. Although COVID presented novel and considerable challenges to our banking system, the system held. And these recent events represent the first real stress event since the 2008 crisis, when banks dealt with run risk and serious liquidity concerns. What we've learned is that we now have to reinforce our banking system against bank runs that can occur at the speed of the internet. This will require stronger emergency liquidity provision to banks under attack, and it has to be available 24 hours a day, 7 days a week. This will then require liquidity providers to have a clear and simple means of knowing that they are loaning to an entity which will ultimately remain solvent. I also believe that we have a lot to learn by the two side-by-side bank failures, Silicon Valley Bank with total assets less than 1% of GDP, and Credit Suisse with total assets greater than 100% of Swiss GDP. And the difference, I believe, is contingent capital. Had we followed Congress's direction to include contingent capital into the stacks of U.S. large banks, we would have been able to resolve the SVB without hitting the Deposit Insurance Fund. And I'll be bringing that up in my questions and yield back.
Today we'll hear testimony from the Honorable Michael S. Barr, Vice Chair of Supervision of the Federal Reserve Board of Governors, the Honorable Martin J. Grunberg, Chairman of the Board of Directors of the Federal Deposit Insurance Corporation, and the Honorable Nellie Lang, Undersecretary for Domestic Finance of the U.S. Department of Treasury. We thank each of you for your time, and we're going to be recognized for 5 minutes for our oral presentation of your written testimony. We'll begin with you, Mr. Barr.
Chairman McHenry, Ranking Member Waters, and other members of the committee, thank you for the opportunity to testify today on the Federal Reserve's supervisory and regulatory oversight of Silicon Valley Bank. Our banking system is sound and resilient, with strong capital and liquidity. The Federal Reserve, working with the Treasury Department and FDIC, took decisive actions to protect the U.S. economy and to strengthen public confidence in our banking system. These actions demonstrate that we are committed to ensuring that all deposits are safe. We will continue to closely monitor conditions in the banking system and are prepared to use all of our tools for any size institution as necessary.
If the gentleman will dispense for a second. Mr. Foster, you'll turn off your mic. Thank you. We'll let you continue. Thank you.
Shall I proceed?
Oh, all right. Go ahead. If everybody will check your mics and make sure you're off. Did you just do that to Mr. Torres? All right. See, we can even have a sense of humor in the midst of serious stuff. We'll let you continue. Thank you, Vice Chair Barr.
Thank you, Mr. Chair. We will continue to closely monitor conditions in the banking system and are prepared to use all of our tools for any size institution as needed to keep the system safe and sound. At the same time, the events of the last few weeks raise questions about what more can be done and should be done so that isolated banking problems do not undermine confidence in healthy banks and threaten the stability of the banking system as a whole. At the forefront of my mind is the importance of maintaining the strength and diversity of banks of all sizes that serve communities across the country. SVB failed because the bank's management did not effectively manage its interest rate and liquidity risk, and the bank then suffered a devastating and unexpected run by its uninsured depositors in a period of less than 24 hours. Immediately following SVB's failure, Chair Powell and I agreed that I should oversee a review of the circumstances leading up to SVB's failure. In this review, we are looking at SVB's growth and management, our own supervisory engagement with the bank, and the regulatory requirements that applied to the bank. The picture that has emerged thus far shows SVB had inadequate risk management and internal controls that struggled to keep pace with the growth of the bank. Supervisors began delivering supervisory warnings near the end of 2021. Our review will consider whether these supervisory warnings were sufficient and whether supervisors had sufficient tools to escalate them. We are also focusing on whether the Federal Reserve's supervision was appropriate for the rapid growth and vulnerabilities of the bank. While the Federal Reserve framework focuses on size thresholds, size is not always a good proxy for risk, particularly when a bank has a non-traditional business model. Turning to regulation, we are evaluating whether application of more stringent standards would have prompted the bank to better manage the risk that led to its failure. We are also assessing whether SVB would have had higher levels of capital and liquidity under higher standards, and whether such higher levels of capital and liquidity could have forestalled the bank's failure or provided further resilience to the bank. We need to move forward with our work to improve the resilience of the banking system, including the Basel III endgame reforms, a long-term debt requirement for large banks, and enhancements to stress testing with multiple scenarios so that it captures a wider range of risk and uncovers channels for contagion, like those we saw in the recent series of events. We must also explore changes to our liquidity rules and other reforms to improve the resiliency of the financial system. In addition, recent events have shown that we must evolve our understanding of banking in light of changing technologies and emerging risks. Part of the Federal Reserve's core mission is to promote the safety and soundness of the banks we supervise, as well as the stability of the financial system, to help ensure that the system supports a healthy economy for U.S. households, businesses, and communities. Deeply interrogating SVB's failure and probing its broader implications is critical to our responsibility for upholding that mission. Thank you, and I look forward to your questions.
We'll now recognize Chairman Grunberg.
Thank you, Mr. Chairman. Chairman McHenry, Ranking Member Waters, and members of the committee, thank you very much for the opportunity to appear before you today to address the federal regulators' response to the recent bank failures. On March 10th, just over 2 weeks ago, Silicon Valley Bank, or SVB as it's known, with $209 billion in assets at year-end 2022, was closed by the California Department of Financial Protection and Innovation, which then appointed the FDIC as receiver. The failure of SVB, following the March 8th announcement by Silvergate Bank that it would voluntarily liquidate, signaled the possibility of a contagion effect on other banks. On Sunday, March 12th, just 2 days after the failure of SVB, another institution, Signature Bank of New York, with $110 billion in assets at year-end 2022, was closed by the New York State Department of Financial Services, which also appointed the FDIC as receiver. With other institutions experiencing stress, serious concerns arose about a broader economic spillover from these failures. After careful analysis and deliberation, the boards of the FDIC and the Federal Reserve voted unanimously to recommend, and the Treasury Secretary, in consultation with the President, determined that the FDIC could use emergency systemic risk authorities under the Federal Deposit Insurance Act to fully protect all depositors in winding down SVB and Signature Bank. It's worth noting that these two institutions were allowed to fail. Shareholders lost their investment, unsecured creditors took losses, the boards and the most senior executives were removed. The FDIC has authority to investigate and hold accountable the directors and officers of the banks for the losses they caused to the banks and for any misconduct in the management of the banks, and the FDIC has already commenced those investigations. Further, any losses to the FDIC's deposit insurance fund as a result of uninsured deposit insurance coverage will be repaid by a special assessment on banks as required by law. The FDIC has now completed the sale of both bridge banks to acquiring institutions. My written testimony today describes the events leading up to the failures of SVB and Signature Bank and the facts and circumstances that prompted the decision to utilize the authority in the Federal Deposit Insurance Act to protect all depositors in those banks following those failures. It further describes the management and disposition of the bridge institutions that were established. It also discusses the FDIC's assessment of the current state of the U.S. financial system, which remains sound despite these events. And in addition, it shares some preliminary lessons learned as we look back on the immediate aftermath of this episode. In that regard, the FDIC will undertake a comprehensive review of the deposit insurance system and will release a report by May 1 that will include policy options for consideration related to deposit insurance coverage levels, excess deposit insurance, and the implications for risk-based pricing and deposit insurance fund adequacy. In addition, the FDIC's chief risk officer will undertake a review of the FDIC supervision of Signature Bank and will also release a report by May 1. Further, the FDIC will issue in May a proposed rulemaking for the special assessment for public comment. The bank failures demonstrate the implications that banks with assets over $100 billion can have for financial stability. The prudential regulation of these institutions merits serious attention, particularly for capital liquidity and interest rate risk, and also the consideration of a long-term debt requirement to facilitate orderly resolution. Recent efforts to stabilize the banking system and stem potential contagion from these failures have ensured that depositors will continue to have access to their savings, that small businesses and other employers can continue to make payrolls, and that other banks, small, medium, and large, can continue to extend credit to borrowers and serve as a source of support. The FDIC continues to monitor developments and is prepared to use all of its authorities as needed. The FDIC is committed to working cooperatively with our counterparts at the other federal regulators, as well as with policymakers in the Congress, to better understand what brought these institutions to failure and what measures can be taken to prevent similar failures in the future. Mr. Chairman, that concludes my statement. I'd be glad to respond to questions.
Thank you. Undersecretary Lang.
Ranking Member Waters, members of the committee, thank you for inviting me to testify today and for the opportunity to speak several times in recent weeks to share updates from Treasury regarding current events. The American economy relies on a healthy—
If you'd pull your mic closer and or direct it towards you. Thank you.
The American economy relies on a healthy and diverse banking system, one that includes large, small, and mid-sized banks, and provides for the financial needs of families, businesses, and local communities. Nearly 3 weeks ago, problems emerged at 2 banks with the potential for immediate and significant impacts on the broader banking system and the economy. The situation demanded a swift response. In the days that followed, the federal government took decisive actions to strengthen public confidence in the U.S. banking system and to protect the American economy. On March 9th, depositors of Silicon Valley Bank withdrew $42 billion in deposits in a period of just a few hours. After concluding that significant deposit withdrawals would continue the next day, the California state regulator closed SVB and appointed the FDIC as receiver. 2 days later, the New York financial regulator closed Signature Bank, which also had experienced a depositor run, and appointed the FDIC as receiver. Treasury worked to assess the effects of these failures on the broader banking system, consulting regularly with the Federal Reserve and FDIC. On Sunday evening, recognizing the urgency of reducing uncertainty for Monday morning, Treasury, the Federal Reserve, and the FDIC announced a number of actions to stem uninsured depositor runs and to prevent significant disruptions to households and businesses. First, the boards of the FDIC and the Federal Reserve recommended unanimously, and Secretary Yellen approved after consulting with the President, 2 actions that would enable the FDIC to complete its resolution of the 2 banks in a manner that fully protects all of their depositors. These actions ensured that businesses could continue to make payroll and that families could access their funds. Depositors were protected by the Deposit Insurance Fund. Equity holders and bondholders of the banks were not covered. Second, the Federal Reserve created the Bank Term Funding Program, a new facility to provide term funding to all insured depository institutions eligible for primary credit at the discount window, based on their holdings of Treasury and agency debt securities. This program, along with the pre-existing discount window, has helped banks to meet depositor demands and bolstered liquidity in the banking system. This 2-pronged, targeted approach was necessary to reassure depositors at all banks and to protect the U.S. banking system and economy. These actions have helped to stabilize deposits throughout the country and provided depositors with confidence that their funds were safe. In addition to these actions, on March 16th, 11 banks deposited $30 billion into First Republic Bank. The actions of these large and mid-sized banks represent a vote of confidence in the banking system and demonstrate the importance of banks of all sizes working to keep our economy strong. Moreover, on March 20th, the deposits in certain assets of Signature Bridge Bank were acquired from the FDIC, and on March 26th, the deposits in certain assets of Silicon Valley Bridge Bank were acquired from the FDIC. We continue to closely monitor developments across the banking and financial system and coordinate with federal and state regulators. As Secretary Yellen has said, we have used important tools to act quickly to prevent contagion, and they are tools we would use again to ensure that American deposits are safe. Looking forward, while we do not yet have all the details about the failures of the 2 banks, we do know that the recent developments are very different from those of the global financial crisis. Back then, many financial institutions came under stress because they held low credit quality assets. This was not at all the catalyst for the recent events. Our financial system is significantly stronger than it was 15 years ago. This is in large part due to the post-crisis reforms for stronger capital and liquidity. As you know, the Federal Reserve announced a review of the failure of SVB and the FDIC a review of Signature Bank. I fully support these reviews and look forward to learning more in order to inform any regulatory and supervisory responses. We must ensure that our bank regulatory policies and supervision are appropriate for the risks, old and new, that banks face today. Thank you to the committee for its leadership on these important issues and for inviting me here to testify today. I look forward to your questions.
I recognize myself for 5 minutes for questions. Undersecretary Lang, when did you become aware of the severe financial distress of Silicon Valley Bank?
Chairman
Date and
McHenry,
time would be helpful.
We became aware.
When did you become aware? I'm going to
I
you.
became aware of issues at Silicon Valley Bank on Wednesday or Thursday.
Wednesday or Thursday?
Yes.
I would like to have a written response to when you became aware. You can search your email, that'd be helpful. Vice Chair Barr, when did you become aware?
Thank you, Mr. Chair.
When did you become aware of SVB's
Sorry.
financial distress?
I was going to answer that. Thursday morning, I received an email from staff indicating that Wednesday evening, the bank had difficulty.
Thursday morning. When did you become aware, Vice Chairman?
I believe it was Thursday evening, staff came into a meeting I was at. taking
Thursday
part
evening
in.
for Silicon Valley Bank. Okay. Along those lines, and you had a staff presentation in February that included Silicon Valley Bank and the distress because of rising interest rates on their portfolio. What did you do between that February staff presentation to you and the week of March 6th about Silicon Valley Bank?
Staff presented on the interest rate risk.
Yes, that's what I said. That was the February presentation. What did you do as Vice Chair of Supervision between that time and the bank, the week of the bank failure?
Staff indicated that they were completing their review of the bank and of this broader horizontal review at that time, and I was waiting for the results of that review.
Were you aware of Silicon Valley Bank raising capital the week of March 6th?
I believe I became aware of that in this email that I described to you
On Thursday morning, that they had successfully raised the capital, but they were facing financial distress.
I was not aware Thursday morning that there were deposit outflows. I was trying to finish the answer to that question. I was aware of the difficulty Wednesday night in raising capital, but the bank was reporting to supervisors Thursday morning that deposits were stable.
When did you become aware of the deposit flows? On Thursday.
Thursday afternoon, late afternoon, I became aware of deposit flows, and Thursday evening that there was essentially a bank run.
So Thursday afternoon, which could be mid-morning in California? Is that what you're suggesting?
I believe it was around noon in California, and for me, around 3 o'clock.
Okay. And did you make provision for the discount window or pledgeable assets at that time you heard of their distress?
My understanding from the staff is they were in discussions with the bank itself beginning Thursday afternoon to try and move pledgeable collateral over to the discount window. That work continued Thursday afternoon, Thursday evening, and actually overnight.
Did you make provision to keep the discount window open so they could provision collateral to avoid a bank collapse?
The discount window opening decision is sort of like a standard thing. It normally closes.
A standard
at 7
thing,
p.m.
except in a moment of crisis. It can be kept open. I think the Vice Chair for Supervision should be able to make that phone call. Did you provision for that? Or
Mr.
did you
Chairman-
think you needed a provision for that?
Mr. Chairman, at the time, my understanding was that the difficulty wasn't sending funds. The difficulty was actually getting the collateral, evaluating the collateral, and getting it pledged to the discount window. And staff were working with Silicon Valley Bank basically all afternoon and evening and through the morning the next day to pledge as much collateral as humanly possible to the discount.
So on Friday morning, Vice Chair, Chair Grunberg, you were appointed receiver. When did you become aware that FDIC was going to have to take this measure or was going to receive this bank?
I think when we were informed Thursday evening.
I mean, were you
Yeah,
informed
I was
Thursday? evening?
informed Thursday evening by staff that
Which meant you had Friday morning conference calls to make a decision. Was that part of it?
I think we were, I think we knew Thursday evening that the bank was going to fail and that we needed to make provision to take over the institution.
Did you pick up the phone and call the Vice Chair of Supervision at the Fed and say, how can we provision to keep this institution open for a Friday?
I can't recall that. My recollection is, Mr. Chairman, that the institution was experiencing a liquidity failure and that it was going to fail. And
It was
that
going to fail on Friday open or Friday evening? Were you provisioning for this for the weekend decision?
No, I think the expectation and their experience was that the institution was going to be closed in the morning.
At what point did you open an auction for Silicon Valley Bank? On Friday?
I believe it was Sunday afternoon.
Sunday afternoon, you opened for auction. So that weekend, what happened we only heard the announcement of Congress receiving this information at 11:20 on Friday morning. There was an idiosyncratic bank. And Sunday afternoon was the next pronouncement from any of you three on the panel, and it was a systemic risk designation. That's what shook the market for the last 2 weeks. That's the reason why we've had these extraordinary interventions in the financial system. And I want to know the key details of that weekend. I hope we can drill into those questions.
Sure.
With that, I'll recognize the ranking member for 5 minutes.
Thank you very much, Mr. Chairman. Chair Grunberg, we know that SVB Bank, nearly half of all U.S. venture-backed startups, potentially tens of thousands of companies, which clearly pose a concentration risk to the bank. While most of the bank's depositors were small and mid-sized businesses, they also had large customers too, with the top 10 accounts holding more than $13 billion in combined deposits. Chair Gruenberg and Vice Chair Barr, I'm concerned that depositors' decision to run or stay were not necessarily made on their own, but by the strong encouragement of their venture capital backers who sit on the boards and hold equity in their companies. Were a handful of large venture capital depositors able to influence the withdrawal of $42 billion all at once through their control over their portfolio companies?
Congresswoman, I think that is something we'll need to look at in terms of the post-failure review of these institutions. I couldn't tell you today, with certainty what occurred there. I know both the Fed in regard to SVB and we in regard to Signature are going to do a careful review of the events that occurred.
Thank you very much, and I agree with you. I think we really need to know the role that venture capitals played in this bank. Going further, Vice Chair Barr, you said yesterday that SVB received a 3 for its management rating, which is considered deficient, but was considered sufficiently capitalized, given the bank's unique customer base, extremely large share of uninsured deposits, and underwater asset portfolio. Liquidity management was also a key issue. The liquidity rating for a bank should account for interest rate risk and the bank's asset liability management. What was the bank's rating on liquidity?
Thank you, Representative Waters. My understanding is in the summer of 2022, although the composite rating was a 3, that is not well managed, the liquidity rating was a 2, which would have been satisfactory. And one of the things we're looking at in the review is how that synced up with the supervisory matters requiring attention and matters requiring immediate attention with respect to liquidity that had previously been issued. So we're looking at whether those standards were sufficiently stringent, whether the firm should have been downgraded further, and whether further supervisory steps should have been taken.
Whose responsibility was it, understanding the deficient rating, to do something?
The Federal Reserve is responsible for supervising this institution.
Did the Federal Reserve fail on that?
I think that anytime you have a bank failure like this, bank management clearly failed, supervisors failed, and our regulatory system failed. So we're looking at all of that.
Thank you. Vice Chair Barr, you said yesterday that SVB received a 3 for its management rating. And you just responded in a way that says, yes, that is true, and perhaps something should have been done, and you're going to look further at that. Are you suggesting perhaps legislation to deal with that?
We're focusing in our review on our own supervision, ways that we could have done better as supervisors at the Federal Reserve, and ways that our own regulatory structure might have played a role with respect to the failure of this firm. So we're inward looking. It's a self-assessment, a prudent thing, I think, for us to do. It's what we tell banks to do. It's sort of the first thing you have to do to understand risk within your own institution, and that's why we're doing it.
Chair Barr, I wonder what it would take to receive a 3, 4, or 5 from a federal examiner. Well, I know the idea is to keep exam ratings confidential in order to prevent bank runs, but doing so also prevents this committee from understanding how well the Fed and other regulators are doing in rating banks. In the same way that stress testing results are public, are there ways we can make the supervisory process more transparent to promote discipline and accountability?
Thank you, Representative Waters. I think one of the things we're trying to do here today is to provide that accountability, and we'll do that in our report, which we'll do on May 1st. It will include confidential supervisory information. We normally do not provide that information, but given the fact that this bank failed and triggered a systemic risk exception, we're including that information, including exam reports.
Thank you very much. Very important issue. Chair Gruenberg, Silicon Valley Bank was purchased over the weekend by First Citizens Bank and Trust Company. As you know, I wrote to you on March 18 about former SVB's community benefits plan which was intended to provide $11 billion in small businesses, housing, and community development support to communities in my home state of California and in Massachusetts. I understand that $2 billion in affordable housing and other projects may be lost or delayed in California because of the failure. Will Citizens Bank and Trust continue implementation of the former bank's community benefits plan?
The agreement between the community organizations in Silicon Valley in regard to the community benefits agreement was an agreement between those two parties. First Citizens will now be taking over Silicon Valley. There'll be an opportunity for the community organizations to engage with First Citizens. I know First Citizens has a community benefits agreement with community organizations where it's currently doing business. So there'll be an opportunity for the groups in California to engage with Citizens. And I would note Citizens is also subject to supervision under the Community Reinvestment Act. And so we'll be able to evaluate the degree to which Citizens is serving its
Ladies-
communities pursuant to CRA.
Gentlelady's time has expired. We'll now recognize the Vice Chair of the full committee, Mr. Hill of Arkansas, for 5 minutes.
Thank the chairman, thank the ranking member for this prompt hearing after these weeks of tumult, and thank the panelists for being here as well. Mr. Barr, when were you nominated for your job?
I apologize, I don't have the date in my head. It was the spring of last year.
And do you know when you were confirmed for your job?
Yes, I took my post up in July of last year, July 2022.
July of 2022. So between January 20th, 2021 and July of 2022, who was in charge as Vice Chairman of Supervision at the Federal Reserve?
There was no vice chairman for supervision during that time period.
And so when that happens, what's the Fed's process for delegating that authority to another member of the Board of Governors or a staffer, or how's that work?
I apologize. I don't know the technical answer to that question. We'll have to get back to you with a written
Yeah, if
response
you
about
get
that
back to me,
delegation.
because what we're saying to my colleagues here is that from the turn of administration, we did not have a Vice Chairman of Supervision from January 2021 until July of 2022. And that is precisely the timeframes, colleagues, when this bank's business strategy went awry and was under this supervisory concern by the San Francisco Fed. So I just want to have that in the record. And when I look at the results of this bank and the UBPR, the call report data, and looking at your good testimony about the timeline that you've disclosed, it appears to me that we have a lack of supervisory urgency here. You outline that the trends in 2021 are what triggered concern by the Federal Reserve examiners, and I assume the state of California. We haven't heard from the state of California. We'd like to. But there was an exam in the summer of 2021, and then there was, it took till the fourth quarter of 2021 to tell the bank we had some specific serious concerns, so that you met with the board then, not you, but the supervisors. And then the downgrades didn't come, and those tough visits didn't come till the summer of 2022. So really 12 months of discussion between the board and the state of California and the San Francisco Fed. That doesn't sound like a very urgent supervisory process. What is it? Do you consider that urgent to take a full 12 months in that process?
Mr. Hill, I think you raise an absolutely essential question. It's one of the things we're going to be asking in our review. Obviously, these events occurred before I arrived at the board. I'm going back and looking at what steps were taken and not taken. And I think it's a completely fair question. Should the supervisors really, been much more aggressive in the way that they responded to the risks that they saw and they were noting? And we're gonna look carefully at that.
Yeah.
I think it's
I
fair.
was shocked with the business plan, way out of line with peer. You have matters requiring attention, which is a very low level, the lowest level editorial comment by a bank regulator. There was no proposal for a board resolution that I saw in your notes. So I look forward to the results of your comments. On this issue of Dodd-Frank versus S2155, my reading of bank law, just those things are just almost not important compared to 12 USC 1818 on cease and desist, where the FDIC, The primary bank regulator, the state, can do whatever they want to a bank that's not operating in a safe and sound manner. Isn't that right, Mr. Barr?
The bank regulators have substantial discretion to use those authorities
Right.
when banks are operating in an unsafe and unsound manner. I agree with that.
And I thought Senator Crapo's comment yesterday was very, very important, that in the rule of construction, that final bit of information in S-2155, the bipartisan bill, bicameral bill signed by President Trump, it says nothing in this bill shall be construed to limit the supervisory authorities for safety and soundness in any way. Isn't that what that rule of construction says?
Yes, I agree with that. I think we have substantial authority under existing law to regulate firms and supervise firms in a way that is appropriate for their risk and size and complexity.
Thank you very much. Mr. Chairman, talking about the resolution process, are you open to a full investigation, not only of the deposit insurance and not only of the supervisory process, but also look carefully at the resolution process itself?
Yes, Congressman.
And are you going to conduct that yourself, or would you work with us on that?
Well, we would certainly be prepared to undertake that review and be transparent with you in regard to it.
Something I want to see considered, and I argued this back in 2008 as a private citizen and banker, which is in the resolution process to consider non-bank buyers for these assets. Do you agree that's important? We should consider that?
Yes, it is, Congressman.
Thank you. I yield back.
We'll now recognize Ms. Velasquez of New York for 5 minutes.
Thank you, Mr. Chairman. Mr. Barr, the rescue of depositors in Silicon Valley Bank demonstrates that regulators think banks like Silicon Valley pose a systemic risk to the system, just like Gypsy do. Mr. Barr, don't you think Category 3 and 4 banks should face the same rules as the mega banks?
Thank you very much for that question. We are looking at capital and liquidity standards for all large banks, including firms 100 billion and above. I still think a tiering approach makes some sense. It doesn't have to be the same rules for all banks, but we do need stronger rules for firms of this size. Stronger rules on capital and liquidity, I think, are going to be really important.
Mr. Barr, in my view, the decision to insure all depositors was a necessary and correct step. However, I am frustrated that time and time again we fail to regulate them like one, and as a result we find ourselves in situations like the one that we are currently in. Without proper regulations that account for the systemic risk profile of a bank, we are incentivizing bankers to search for yield and inviting moral hazard. Mr. Barr, the sudden and immediate collapse of Silicon Valley Bank demonstrates the vulnerability of banks and the broader system to interest rate rises. Yet, under our current capital rules, most banks are not required to recognize this risk, only G-SIBs. Will the Fed rewrite its rule to require all banks to account for interest rate risk?
Well, you raise an absolutely essential point, and one that we are very carefully looking at. We anticipate engaging in a notice and comment rulemaking process on capital rules with appropriate transitions, and that is one of the areas that I think would be important for us to consider in that rulemaking process.
So do you think that the rules passed under S-2155 and written by the Trump administration need to be rewritten?
We're going to look as part of our review at not only our supervisory issues, but also at the regulatory structure that the Federal Reserve put in place in 2019 and see whether the size thresholds we used, the standards we decided to put in place, all of that is on the table. We're reviewing that. We're going to come back and provide an assessment of that on May 1st.
Thank you. And Mr. Barr, the Fed has been raising interest rates more rapidly than it has in decades in an effort to lower inflation. It appears that many banks were unprepared for this. Can you explain how the Fed's bank supervision staff coordinate with its monetary policy-focused staff to ensure that banks are properly prepared for well-telegraphed shifts in monetary policy? Does the Fed see regulation and supervision as separate from monetary policy?
the whole of the Federal Reserve staff communicate very well together. As you noted, the monetary policy decisions were very well telegraphed. The decisions were essential to meet our congressional mandate of price stability and maximum employment. And we need to make sure that we continue to pursue that. We have separate tools that we use, of course. And as I said in other contexts, interest rate risk management is a core bread and butter issue in banking. It's not an esoteric issue, an exotic issue, a complicated issue. It's a straightforward issue, and the bank management failed to do that here.
Thank you. And during his news conference last week, Chairman Powell said that the FOMC considered a pause in the interest rate increases in light of the recent banking failures, but ultimately unanimously approved the decision to raise rates due to intermediate data on inflation and the strength of the labor market. How will the Fed balance its supervisory role with its monetary policy role as it considers future interest rate increase?
We have really all the tools that we need on the macroprudential and microprudential side to assess financial stability and bank safety issues. And as I said, the banking system overall is sound and resilient. Deposits are safe. On the monetary policy side, we're going to be looking at incoming data. We're going to be looking at changing financial conditions, and we'll really make a judgment on a meeting-by-meeting basis about that decision.
Thank you. Mr. Chairman, I yield back.
We'll now recognize Mr. Sessions for 5 minutes.
Mr. Chairman, thank you very much, and thank you to the witnesses for being here today. I think you see that this committee will work together, has questions, and would wish to hold you accountable, but I must confess to you, after hearing the questions that have taken place, I've heard none of you three accept real responsibility for your role in this endeavor. I've heard that you were aware of it the week of. I've heard that notice was given of oversight back in 21, that a frailty was noticed. I've heard us say that we used all of our tools. I've heard you say things like the FDIC will use all of its authorities. But I've not heard any of you three talk about a systematic failure. Let the bosses know what's happening. I've heard the use, well, this got staffed and that got staffed and staff did this. I think this is a wake-up call to all three of you. I hope it's a wake-up call to your organization, that evidently they can see these bread and butter failures back in 2021, but evidently nothing realistic ever occurred to avoid what seemingly anybody that's a professional banker could see. I've seen excessive regulatory oversight by this administration across the board. I've seen a lot of what I would call inattention by decision makers. So I would specifically tell you that we will drill down on and need to know more about the recommendation for systematic exception that was invoked. In other words, that was invoked by presumptively the people at this table, and yet it took all this time to filter up before you were even aware. Failure was occurring, and then you were given notice. So I would hope myself that there would be some inward thinking about your actual roles. Instead of staffing everything and waiting for it to bubble up to you, that there should be hooks in place. I spent 16 years in the private sector, ran a large organization, over 700 employees. I had more than a fiduciary responsibility. I had a managerial responsibility to report up the things that we saw to a very large organization. And I believe by and large, those people welcomed my feedback and set ourselves up for that. So take the remaining minute and 50 seconds and give me some inward thinking, because I heard no one say we were part of the problem. We need to look at us being part of the problem, and we need to be a part of the solution because, as was noted, this will be paid by all banks across the country of the FDIC. Please. Mr. Barr?
Thank you very much, Mr. Sessions. I agree with you. I think we need to take a good, hard look inside at the Federal Reserve, at our supervision, at our regulation. I think we need to be humble about that. And I think we are going to be unflinching in our review about that.
Does that include your role?
Absolutely. Absolutely. And I'm here today to be accountable to you for that purpose.
Well, accountable is one thing, but coming back and actually admitting that you were part of the systematic failure is an entirely different process. People say, well, we'll hold accountability, but actually it's banks that are across the country that play by these rules and offer this money are the backstop. And while I don't want to argue against that, I do want to say, I believe there's lots of room to say someone should have caught this as early as and done something back in early 22. Chairman?
Congressman, I really don't mean to shirk responsibility here. I think we share responsibility. I think bank management had responsibility. I think we as the regulators of the institution had responsibility. I think we're going to conduct reviews to get the facts as to what occurred and a measure of internal as well as external accountability. My own sense here in terms of the supervision of these institutions from my perspective is that both agencies, and I would include ourselves, were aware that there were issues at these institutions and trying to address them through the supervisory process. It's also my judgment, I think, and we're going to conduct a review to get all the facts here, if I may say.
The gentleman can answer the rest for the record. With that, we'll now recognize Mr. Sherman of California for 5 minutes.
Due to Dodd-Frank, our banking system is strong. Our regulators avoided a crisis by quick action this month. But the solution was not free. Some $22 billion of special assessments will be imposed on banks. That will lead to lower rates on certificates of deposit, perhaps 0.25%, perhaps 0.1%. And our entire economy has been hurt. It's been rattled by what happened this month. Our bank regulatory system has some real flaws. It's an undemocratic system in which FASB writes the accounting rules and doesn't even claim to be part of a democratic government. The Federal Reserve Board's regional banks, it's not one person, one vote, it's one bank, one vote. The bankers vote on who's on the regional board, and the bankers of my state elected the CEO of Silicon Valley Bank. Banks get to pick their regulators, state or federal, holding company or no holding company, Fed or OTC. They can use regulatory arbitrage, and every regulatory agency knows that if it gets a reputation of being too tough, the banks can flee and go to one of their regulatory competitors. Our accounting system for banks is absolutely perverse. If you make a Main Street loan, you're penalized under the CECL system, and you will always list that loan on your balance sheet as being worth less than you paid for the note. If you instead go to Wall Street and buy long-term bonds, you are rewarded. If the bond goes up in value, you can sell it or classify it as available for sale and recognize a profit and justify a bonus. If the bond goes down in value, you can hide it by listing it as held for maturity and list it at the original purchase price on your balance sheet, even though you know it's worth 20 or 30% less. The crypto billionaires fanned the flames because they understood that if they can besmirch our banking and dollar system, crypto goes up, and they've made tens of billions of dollars. Silicon Valley Bank could have saved itself in 2022 by hedging its risk or selling its long-term bonds, but they knew that would cut profits and bonuses. They decided to take the risk, and here we are. And of course, our clawback provisions are inadequate. There are 600 billion of unrecognized losses on the balance sheets of American banks. That needs to be juxtaposed with the $2.2 trillion of capital American banks have. So we're overstating the capital of our banking system by perhaps a quarter. Mr. Barr, particularly watched your Senate testimony in which you basically said it was bank mismanagement for them to ignore the good advice your people gave them. It is also misregulation to let banks ignore that advice. You are not running a consulting operation. You are running a regulatory operation who can force banks to follow that advice. And interest rates go up, interest rates go down. Certainly the Fed in auditing banks ought to know that, especially when this is not a 100-year event. Interest rates go up, interest rates go down. I mean, 2023 has its peculiarities, but it's particularly ironic. It's the Fed that's raising the interest rates, and then the Fed that's not examining banks to see if they can survive if interest rates go up. The concern we all have is, are there other banks that could go under because they invested in long-term bonds that aren't worth as much as they paid for them? So I'll ask Mr. Gunberg and perhaps Mr. Barr, are there any banks out there, and roughly how many, that have capital of under 5% if you subtract from their stated capital their unhedged, unrealized losses on long-term debt?
Congressman, that's a fair question and a factual question. If I may, let us get back to you on that. We'll get the numbers and share them with you very quickly.
And please don't give me the names. Mr. Barr, do you have any other answer?
No, sir.
Mr. Gunberg, I know that you're going to be giving us a report about possibly expanding FDIC insurance this spring. I look forward to it. And I hope that you would consider $3 million of coverage, but only of non-interest bearing accounts. Because when a bank is used as a utility for a checking account, we need that coverage. If people are making investments, we ought to be a little bit more careful, and I'll yield
We'll
back.
now go to the Subcommittee Chair on National Security, Mr. Lukemeyer, for 5 minutes.
Thank you, Mr. Chairman. Vice Chair Barr, for more than a year now, financial news has focused on Fed raising rates. There isn't a person in the financial services sector of the country that hasn't heard about it on a seemingly everyday basis since the beginning of 2022. Well, it has been the fastest rate increase in our country's history, which I believe is probably too fast. Chairman Powell has made his intentions very clear. No banks should have been caught off guard by rate increases. In fact, the Federal Reserve is in the same position themselves. Mr. Powell was here a couple weeks ago and acknowledged that his bond holdings have got them, and the interest rate situation that they have is actually losing money as a result of this himself. So it's even more surprising that a $100 billion bank's not considering the effect of rate increases is, in fact, according to your testimony, the Fed staff hasn't presented to the Board of Governors with its impacts on rising rates until mid-2023, February 2023, just last month. So are you telling me that every time the Fed raises rates or dropped rate, there is no economic analysis done on the impact on our economy?
Mr. Lukemeyer, I was referencing that particular meeting because the staff.
No, that's not my question. My question is, does the Fed, before it raises rates or lowers rates, does it have an economic study done by its economists? They've got a team of economists there. Do you have an economic analysis done of the impact of that? Mr. Gabarino, would you please move to your right, please? Thank you.
Yes, we evaluate all the economic conditions.
Do you get a report from your
financial
economists
conditions
that the
when
Fed
making any interest rate
that the
decision.
Fed that you do? Does the Fed board get a report from their economists saying what the impact of their rates will be on the economy? Yes or no?
Yes, we get staff forecasts that forecast the expected impact on the economy of rate decisions.
Okay, how come you made a specific mention that of this in your February report then? Is that why did you specify that you got the rate?
Well, that's what I was trying to explain earlier. I mentioned that because the report specifically called out Silicon Valley Bank. We regularly discuss interest rate problems.
Okay.
Interest rate risk is an important part of supervision and a bread and butter issue.
Okay. A bank this size, normally you'll have an examiner or two or a team that is in there on a daily basis. Was there an examiner or team of examiners in Silicon Valley Bank on a daily basis?
The team consisted of about 20 full-time equivalent staff at the San Francisco Federal Reserve Bank.
They were not in Silicon Valley then?
I don't know precisely the extent of their in-person meetings versus their remote analytic work.
Okay, that's another problem that we have to talk about, having all this work off-site whenever they need to be on-site, being able to have access to the daily data. But as a result of this, and I'll follow up on some of the questions that have been asked before, but ask them in a little bit different way. You knew that we had an interest rate risk problem and a liquidity problem. You acknowledged it all the way through from 2021. It's been established this morning. You have examiners in the bank are watching it on a daily basis. And you know that you've had some reports that say we need to take some action. Why was no action requested or not forced on the bank?
There was action requested of the bank in the matters requiring attention and matters requiring immediate attention.
Why were they not enforced?
I think that's a question for our review. We don't know. I don't yet know the answer. Could the staff have escalated more? Should they more? What were the interactions with the bank? That's all part of the supervisory record that will be in the May 1st report.
Well, that begs the question then, Mr. Barr. If you think you need more rules and you're not even enforcing existing ones, why do you need more rules? I don't think we need to look at more rules until we figure out which rules were not being enforced, what messages were not being delivered to the bank to be able to do your job. At that point, then we can take a look and see what we need to do something else. But for you to make the statement, we need more rules and regulations, how about enforcing the existing ones first?
We're going to be looking, as I said, at our own supervision under the existing framework, ways in which existing rules.
Very quickly, I've got one more quick question for you here. This situation points out a very unique situation because of the new social media, the world of instantaneously being able to do some things. I have grave concerns because within a less than 2-day period, $42 billion rolled off the books here, basically as a result of a Twitter little informational thing. It begs the question down the road here, Mr. Barr, it opens up the possibility whenever you have a bunch of significantly distressed banks that there could be a short sell on some of these things that could be out there. We need to be talking about that. Are you thinking about that at all yet?
Yes, I think you're raising absolutely important and critical questions about the role of social media, the role of networks, depositors with each other, and the potential.
You're working on a real-time payment system that's going to be ripe for a problem like this with Twitter if we don't fix it
time's
beforehand.
expired. You can
Thank you, Mr.
answer for the
Chairman.
record. We'll now go to Mr. Scott.
Thank you very much. Vice Chair, we know that this was basically the fault of the management. But what we want to know is, where did the Fed go wrong? Where did the Fed go wrong? And specifically, did the Fed miss red flags or ignore warning signs that were brought to you by your staff months or even years before the collapse?
Thank you very much for the question. We do have in the supervisory record staff reaching out to the bank, highlighting these problems. As you noted, in the first instance, it's bank management's responsibility to fix those problems. They didn't do so.
Well, Vice Chair, is it true that the San Francisco Fed, which supervised Silicon Valley Bank, sent multiple warnings to the bank's management about the risk it was taking, including its substantial holdings of treasuries and other bonds that were steadily losing money as interest rates rose?
Yes, the supervisors pointed out to the banks that they were exposed to interest rate risk and liquidity risk, and that they didn't have the risk management in place to address those.
And
the bank failed to fix those problems.
And how often did Fed staff share with the Board of Governors that rising interest rates were threatening the finances of some banks, and in particularly the risk-taking at Silicon Valley banks?
My understanding is that the particular issue with Silicon Valley Bank did not rise to the level of the board until mid-February of this year.
And the other question is
The
this.
Board of Governors, I should say.
Why do you think that the full extent of the bank's vulnerability did not become apparent until it was too late? Especially when the FDIC data was showing that SVB was doubling in size in 20 and 21, doubling in size within 12 months. Was that not a red flag?
Well, I think you raised, I apologize, I didn't mean to cut you off there at
No.
the end. I think that one of the things we're looking at is that the way the Federal Reserve's regulations set up the structure for approach to supervision treated firms in the 50 to 100 billion range with lower levels of requirements, and had a phase-in period for firms that got above the 100 billion line. That meant that their transition into those higher standards took a long time. So by the time the group was actually looked at in an intense way by the group in the large and foreign banking organizations team, a lot of that growth and a lot of that activity had happened. And so in a sense, it was very late in the process. And that's one of the things we're looking at in our review.
Good. And I want you to know that I appreciate your recent announcement that a formal review into whether the Fed failed. It's good to admit failure. That is the first step for correcting the problem. And whether the Fed failed to properly oversee Silicon Valley Bank will take place, and more importantly, that it will be shared with us in the public. Is that true?
Yes, that's absolutely right. We thought that it's really important as a first principle of risk management for us to do our own self-assessment. We have a team of people working on that self-assessment who are not involved in the supervision of Silicon Valley Bank. We're going to make all of those findings and recommendations public on May 1st. And let me also say we welcome other outside reviews, as this body is doing today, and others will as well.
Thank you very much, Vice Chair.
The gentleman from Michigan, Mr. Huizinga, the chair of the Oversight Subcommittee, is recognized.
Thank you, Mr. Chairman. I'm going to quickly move ahead here. A loss in confidence in the banking system is a loss of confidence in regulators in many of our minds. And regulators seem to have had the tools at their disposal to prevent these failures from happening. They seem to have missed that. We're going to be exploring that. As chairman of the Oversight and Investigation Subcommittee, I find it necessary to reiterate how important the congressional oversight is, and that it's a constitutional authority that we have, and frankly, an obligation that we have to maintain the well-being of our system of government. Mr. Barr, you just had said it was appropriate for outsiders to do their independent reviews. That's what we are trying to do here today. You were authorized, though, on March 13 to do your report, correct? Who authorized that?
Chair Powell and I made...
Okay, that's all I need to know. Chair Powell authorized you?
Chair Powell and I jointly made the decision
Okay.
for me to proceed
Great.
with this.
Is it your understanding as well that under Dodd-Frank, anytime 13.3 is invoked and utilized, that the GAO is also supposed to do a report?
I'm not familiar with that precise provision, but it makes sense to me that GAO should do a review.
Okay. And do you know when GAO is going to be starting their report?
I respect the
investigation?
independence of the GAO
Okay,
and would suggest
great.
that
Page 2 of your testimony, you said that the May report will include confidential supervisory information. Will you be providing that CSI to the GAO?
yes, consistent with
Okay.
normal practice.
Right. Well, we might have to unpack that a little bit. Will you also commit to me and this committee and to the chairman that you will provide this committee with all those same related confidential supervisory information needed to appropriately assess on our end what happened.
Yeah, the same information in the May 1st report will be
No,
available.
no, not in the report. You're giving if you're giving that supervisory information for the GAO to do their review, not before you review it yourself and decide what is appropriate and not appropriate. I thought you just said that you would be providing GAO with all of that data and information that you will be using to make your report. Is that correct?
We will make the information that we are using for the report available to you and to the GAO. And
Okay, so we have
and to
your
the public.
commitment that you are going to be providing us with all of that raw, confidential, supervisory information so that we can do our job.
The same information that we'd use for the GAO and for the public report.
I'm not looking for the report, though. I want to make sure we've got the information. I'm trying to make sure that our semantics
trying to
aren't
be
game
careful
played.
we follow our-
I will
follow our rules.
accept the answer that you are going to give us the exact same information in a timely fashion that you are using for your report. Fair?
Yes.
Okay, all right. Mr. Grunberg, I want to touch on the Treasury's commitment. I'm sorry, the FDIC to look at what was going on there. The same question really is to you. Will you commit to providing the committee with all related confidential supervisory information that is needed for us to assess?
Yes,
what is going
Congressman. One, I think you have the authority to compel that information. We'll be responsive to you.
Okay. Timely manner is the key watchword here. Between myself and the chairman, Chairman McHenry, we have a number of requests to all of you. Ms. Lang, want to touch on this to obtain the information. FSOC was convened on both March 10, March 12, and March 24. Has FSOC met since March 24?
They have not met since March.
You have not,
24.
okay. So it was reported that Secretary Yellen convened these officials via video conference. Is that correct?
Yes, I believe there
And you were part of
two
that?
FSOC meetings.
Okay, and you were part of that.
I was part of the second one. I was not part of the first one.
You were not part of the 10th,
I
okay?
was not. That was the evening, I believe, we announced. I was not part of the March
All right.
12th meeting.
Were minutes taken at those meetings?
By normal process, minutes would have been taken.
And will we have access to those minutes
Yes, they are released according to.
before they're released? Because we only have minutes from December 22. There is nothing that has been released publicly since December 22.
That is correct. I believe the process is minutes are released following the next formally scheduled FSOC meeting.
Only if
But
formally
we can-
scheduled.
We can come back to you on that, when they will be released.
So we have to wait till the next formally scheduled time to get those minutes.
I understand that's the process, but
We'll be
can come
following
back
up
to
in
you.
writing. Thank you.
Yes.
We expect a written response for that, Undersecretary. I will now recognize Mr. Lynch of Massachusetts for 5 minutes.
Thank you, Mr. Chairman, and thank you, Ranking Member, for holding this hearing. I want to follow up on Ms. Waters' line of questioning. Prior to its collapse, Silicon Valley Bank was a major lender and investor in low and moderate income housing in Massachusetts, in my district, in large part because it acquired the Boston Private Bank and Trust Company back in 2021. So that includes not only deposits, but construction financing, permanent financing, mortgage lending for low and moderate income home buyers, equity investments, and direct purchase of tax-exempt bonds for affordable housing development. So right now, I've got 18 affordable housing developments in my district and on the outskirts of my district, currently in construction in Massachusetts. And they depend on the fulfillment of outstanding debt and equity commitments that were made by Silicon Valley Bank. So these developments, and this is the back of the envelope, I'm sure there are more, but I have 754 homes, including 702 affordable homes for residents with low incomes and 118 homes for residents with extremely low incomes, as well as workforce housing. So while the vast majority, here's the thing, while the vast majority of high net worth investors and depositors at Silicon Valley Bank have been held harmless, they've been rescued. They've been rescued. The First Citizen Assumption Agreement is completely silent on the status of these low-income victims. And that is a problem. That flies in the face of your mission and mine. And so, Mr. Gruenberg, now, and I appreciate all three of you and the work. You worked quickly once you saw the problem. And I find great fault with the reckless management on the part of Silicon Valley Bank in that they concentrated so much risk and there was an absence of meaningful risk management. But we have a problem. And while the bank crisis might be over, it's not over in my district with all these families, all these low-income families that are struggling. You know, I got cities like Brockton, Massachusetts. We got a great mayor there doing a wonderful job, and they're all going in the right direction, and as well as Boston and Quincy and others. But we need help. We need to resolve this. So, Mr. Gruenberg, I need a commitment from you, sir, that you need to come to Brockton. You need to come to Brockton in my district, and we need to work this through so that we provide the kind of protection for low-income families, a lot of them families of color, many first, they're first-generation immigrants, and, they need help. And I think you and I need to be there, and I'll get my mayors together and these 18 affordable housing development managers, and we'll try to get this done. But can I get your commitment? Any thoughts on that?
Yeah, Congressman, I'd be glad to do that and follow up with you as First Citizens takes over, is in a position to continue to serve the customers of the former institution and work with you in regard to the community issues you just described.
That's great. I'm very happy to hear that. There's something new and different, though, in this collapse. There was a concentration of risk on the part of Silicon Valley Bank. They catered to early stage startups which have a high rate of failure in the first place. They're very skittish, so those aren't core deposits that are going to stay through any period of unsettled economy. And then on top of that, you have panic that is driven by social media. In many cases, you had venture capitalist firms telling their clients at that bank to get the heck out. So the speed at which this happened was a matter of hours. And again, I commend you on the speed at which you acted. But is there something more that we need to be doing now because of the velocity of money? People can move their money out like that. And are we equipped? The FDIC has a long and strong history, but is something new and different needed to protect us from that phenomenon?
Congressman, I think that's an important question to ask. I think we are dealing with a different environment, and the point you raise in terms of how quickly money can move, what the technology enables now that exceeds what's occurred in the past is a new risk factor that we have to think about.
I would ask the panel to all respond to the gentleman in written form about that very, very important subject. I will now recognize Ms. Wagner of Missouri for 5 minutes.
I thank you, Mr. Chairman. And Vice Chair Barr, we're going to go very quickly here, so I would like some succinct, brief answers if we could. Vice Chair Barr, referring specifically to Federal Reserve supervisors, do you know how many citations, specifically the matters requiring attention, MRAs, and matters requiring immediate attention, MRIAs, that were issued to Silicon Valley Bank regarding its management of liquidity risk? Microphone and a number. Do you know how many?
In November 2021, there were 6 MRAs and MRIs on liquidity. In the summer of 2020, sorry, in the fall of 2022, there was an additional MRA on interest rate risk modeling. I think I misidentified inadvertently yesterday as an MRIA, but as an MRA.
That's fine. I don't need you to go through all of them. We've got 6, maybe 7 of these citations that were given. Yesterday, you were asked about an MRIA that was issued in the fall of 2022. You stated that the MRIA was issued, quote, based on the inaccuracies of their interest rate risk modeling. Essentially, the risk model was not aligned with reality. This is your quote.
Yes.
Did the supervisors provide the bank a timeline to remediate this misalignment? Since changing an interest rate risk assessment model seems to be something that could be done very quickly.
Yes, my understanding that there were time limits associated with each of these MRAs and MRAs, but I don't have the information.
Really?
precisely.
Okay. Well, clearly those alerts were ignored at the bank. Why didn't the Fed consider escalating any of these issues into a cease and desist order or other formal enforcement action against the bank to require senior management and the board of directors to remediate these serious deficiencies?
I think you raise a fair point, and we will be looking into that.
I certainly hope so. Vice Chair Barr, in your testimony, you stated, quote, the failure of SVB illustrates the need to move forward with our work to improve the resilience of the banking system. For example, it is critical that we propose and implement the Basel III endgame reforms, which will better reflect trading and operational risks in our measure of banks' capital requirement needs. Sir, I strongly disagree. These reforms will result in additional costs on consumers, on businesses, and investors. I'm gonna go real quickly here. Was trading risk the reason SVB had almost 94% of its deposits uninsured?
No.
Was trading risk the reason SVB did not have a risk officer for nearly 9 months last year?
I do not believe that that was the focus of why there was not a credit
So,
risk officer.
no, trading risk was not the reason. Was trading risk the reason SVB had 51% of its deposits in the tech industry? Yes or no?
Not to my knowledge.
You know, I fail to see how SVB illustrates a need to implement Basel endgame reforms, particularly as it relates to trading risks. Can you show how trading risk directly resulted in SVB failure? Or, sir, are you just looking for any reason, correlated or not, to justify increasing capital requirements for our banks?
I think it's really quite important that we strengthen capital and liquidity requirements in the system. It's something I've been working on since arriving at the board in July. And I think that the work that we're going to do, that we will propose through notice and comment rulemaking, will make the financial system safer and sounder. That reduced risks that firms such as SVB in the future
You stated
might cause
that yesterday that our banks are well capitalized, did you not?
Yes, I have been consisting in saying that both that the system is strong, but that also we need to think about stronger capital rules, and I think that's appropriate given the.
Well, we're
risks.
going to have a hearty give and take on this. You know, I want to say this in closing. Despite U.S. regulators having clear knowledge of insufficient risk management, it seems that the examiners and your supervisors were asleep at the wheel, while signs that Silicon Valley Bank was heading towards a collapse were staring them right in the face for many, many months. Vice Chair Barr, I look forward to the release of your review of the supervision and regulations of Silicon Valley Bank so we can dig in some more on May 1st, and I hope that it provides more clarity to the events leading up to these bank failures. I thank you, and I yield back the balance of my time, Mr. Chairman.
We'll now recognize Mr. Green of Texas for 5 minutes.
Thank you, Mr. Chairman. I thank the ranking member, the witnesses for appearing. Witnesses, you have all made the case for mismanagement at Silicon Valley. If you disagree with this statement, please extend a hand into the air. Let the record reflect that all witnesses agree that mismanagement was occurring. I have before me a news article from what is perceived to be by many a reliable source, CNBC. The style of the article is, that would be the title, the style is Silicon Valley Bank employees receive bonuses hours before government takeover. Hours before government takeover bonuses. It's also alleged by other sources that these bonuses could exceed $100,000. Mr. Gruenberg, is it true that hours before the takeover of the bank, before it was seized, that bonuses were accorded employees?
Congressman, since we weren't the supervisor, I wouldn't have that direct information. I'm sure we could get it for you, or the Federal Reserve could provide it.
I welcome the intelligence from the Federal Reserve.
But if I could just make an additional point, which is the FDIC is under a legal obligation after the failure of Silicon Valley to conduct an investigation of the conduct of the board and the management of the institution. And if misconduct occurred, we do have authority to impose civil penalties, including civil monetary penalties, restitution, and to bar individuals from the business of banking.
Thank
So
you.
we do have some significant authorities
Thank
and
you.
responsibilities.
Thank you. I yield to the FDIC. Excuse me, to the Fed.
Thank you very much, Representative Green. The board also has the authority.
Without the authority right now, just tell me, did the bonuses, were there bonuses given out hours before the bank was seized?
I have seen reporting of that, but I'm still trying to chase down the facts. Our enforcement team has the ability to go after actions against individuals.
So you're saying you do not know, but you have heard that this is the case?
Yes, I do not have the supervisory record of that to know, but I've seen reporting of that, and we're
All right.
looking into it.
For the moment, let's just assume that Bank X hands out bonuses. Management has failed to do its job. Do you have the inherent or accorded or statutory power to claw back those bonuses?
We have the ability to pursue actions for individuals who violated the law.
May I kindly ask about clawback of bonuses? Can you claw back those bonuses?
Under our authority, if there are violations of the law or unsafe or unsound practices or any breach of fiduciary duty, we can get restitution, we can get civil money penalties, and we
So
can have
should
a
I
prohibition of
assume that your answer is no, you do not have the authority to claw back those bonuses?
We don't have generalized clawback authority.
You do not. All right, I see a hand raised. Mr. Gruenberg, please.
Just to try to respond directly to the question, we do not have explicit the FDIC does not have explicit clawback authority under the Federal Deposit Insurance Act. We have that authority under the Dodd-Frank Act in regard to failures under Title II, but we do not have that under the Federal Deposit Insurance Act. So in considering additional authorities that Congress might provide, that might be something worth considering.
Thank you, Mr. Gruenberg, because that's exactly where I'm going. We live in a world where it's not enough for things to be right. They must also look right. And it just doesn't look right for hours before the bank is seized, bonuses to be accorded employees. And some of these bonuses total more than $100,000.
Gentleman's time has expired. We'll now
Thank you.
recognize the Chair of the Financial Institutions Subcommittee, Mr. Barr.
Thank you, Mr. Chairman and Ranking Member, for holding this important hearing. And Vice Chairman Barr, true or false, Silicon Valley Bank experienced rapid asset growth in a short period of time?
Yes, that's correct.
Silicon Valley's rapid growth was fueled by an extremely high concentration of deposits from a single sector.
Yes, that's correct.
Silicon Valley Bank became overdependent on an extremely high percentage of uninsured deposits.
Yes, that's correct.
Silicon Valley Bank failed to hedge the risk of holding long-duration securities in a rising interest rate environment.
My understanding is at one point they had hedges, and those were not in place at the time they failed.
And that was apparent to the Fed.
Yes, it was apparent to the Federal Reserve.
Silicon Valley Bank had no chief risk officer for 8 months before its collapse.
Yes, that is correct.
Was the San Francisco Fed unaware of any of these basic facts in the months leading up to its failure on March 9th?
Not to my knowledge.
So nothing in the existing regulatory framework concealed these basic facts from the San Francisco Fed, which had responsibility of supervising this bank.
The regulatory structure doesn't conceal facts. It may have an effect on how supervisors act with respect to those facts.
True or false, Silicon Valley Bank was subject to enhanced prudential standards under Dodd-Frank as amended by the 2018 bipartisan regulatory relief law.
The Federal Reserve supervisory structure did not apply most enhanced prudential standards to the firm. It did have some enhanced prudential standards once it became subject to those standards after it passed the
Well, let's take
average at the 100 billion level.
before it passed that $200 billion threshold. When it passed the $100 billion threshold, it was under 2155, the bipartisan regulatory relief law, under Section 401A1C of that law. The Fed could have applied enhanced prudential standards to Silicon Valley Bank. Is that correct?
Under the 2019 rules that the Federal Reserve put in place, most enhanced prudential standards did not apply to the firm.
Well, wait a minute. I don't know about that, because under 401A1C of that law, the Fed, by order or rule, could apply enhanced prudential standards to banks not above 200 billion, but above 100 billion in assets on a one-off basis.
Yes, the legislation provided the Federal Reserve with ample discretion. The way that discretion was implemented in 2019 was with a rule, and that rule provided.
But in
some
order,
enhanced
but by
standards,
order, and reclaiming my time, Vice Chair, by order, the Fed could have applied enhanced prudential standards before the bank reached the size it did by February of 2023. My point is, it doesn't seem appropriate to change the tailoring rules for all banks to account for a lapse in supervision by the Fed and the inability of the Fed to deploy enhanced prudential standards to firms when it's currently able to do so under existing law. And Mr. Barr, as you and I have discussed, and as we agree, we need to preserve the diversity of the financial ecosystem here. The Fed had all the existing tools it needed to supervise this bank and apply those enhanced prudential standards. I think pushing a one-size-fits-all or reimposing a one-size-fits-all regulatory regime on community and regional banks, especially regional banks under distress right now, would result in fewer of those institutions, more consolidation, and less competition for too-big-to-fail banks. Mr. Director Gruenberg, the vast majority of community banks in my district are well-managed, and they actually understand how to manage interest rate risk in a rising interest rate environment. And since the failure of Silicon Valley Bank, those Kentucky banks and their customers have been asking me why they should have to pay an assessment for your rescue of Silicon Valley Bank with 100% guarantee of deposits of largely wealthy, sophisticated depositors at Silicon Valley Bank, some of whom apparently cared more about the bank's commitment to environmental sustainability than their capability to be good stewards of their deposits. I think this is a legitimate question. And I also think it's a good question whether invoking the systemic risk exception to the least cost resolution mandate under the Act was in fact the least cost solution. After all, your decision to cover all of the uninsured deposits cost the Deposit Insurance Fund an estimated $20 billion. Will you commit to using your authority under 12 U.S.C. 1817 to establish separate risk-based assessment systems for large and small members of the Deposit Insurance Fund so that these well-managed banks don't have to bail out Silicon Valley Bank?
Certainly willing to consider that, Congressman. And as I indicated, we are going to be preparing a comprehensive review of the deposit insurance system. So we'll come back to you and glad to engage with you.
Gentleman's time has
Thank you, I yield.
expired. We'll now go to Mr. Himes of Connecticut for 5 minutes.
Thank you, Mr. Chairman.
It's interesting to me to listen to my friends on the other side of the aisle who ordinarily spend all of their time trying to defund, destroy, and denigrate your organizations now hold you entirely responsible for where we find ourselves today, despite activities within the bank that I think we all agree, and Mr. Barr, you have said were on the verge of outrageous. So I'd like to begin by thanking all of you and your organizations for the intense and sleepless actions you took beginning on March 9th. I don't know if you acted perfectly, and you don't know if you acted perfectly, but we all know that today the financial system appears to be stabilized. And we certainly know that Congress is not lighting itself on fire, crafting a massive publicly funded bailout as it was in the fall of 2008. I hope that we've dispensed with the absurdity that it was Silicon Valley's woke activities that drove this failure. And while I don't necessarily agree, Mr. Barr, with your predecessor's statement that blaming the bipartisan 2018 reform law is so nonsensical it isn't even wrong, the truth is that Silicon Valley Bank was crawling with supervisors and regulators who had been raising the alarm for a long time. And that's what's interesting to me about this whole episode. It was not a surprise. It wasn't a surprise to the regulators and supervisors who had been raising those alarms for years. It shouldn't have been a surprise to the management team who had been the target of those alarms. By the way, just as a side note, it was a surprise to the Wall Street research analysts who were paid very good money to evaluate Silicon Valley Bank. 24 Wall Street analysts covered Silicon Valley Bank. 11 had buy ratings on it. 11 had hold ratings on it. Only one analyst rated it a sell. More seriously, the credit rating agency, S&P Global, rated Silicon Valley investment grade right up until March 10th, when it announced that it expected a bankruptcy. There's an uncomfortable echo of 2008. By the way, Mr. Chairman, I'd like to insert for the record unanimous consent, a remarkable article by Professor Raj Gopal of the Columbia Business School, which elaborates many of these points that I'm making.
Without objection.
The facts have been put out there pretty comprehensively. In 2021, 2 years ago, the Fed review results in the finding of serious weaknesses, the issuance of 6 matters requiring attention and 1 matter requiring immediate attention. July of 2022, the full supervision review rates the bank deficient. That's 7 to 8 months before March's meltdown. Early 2023, there's a horizontal review. Again, the word deficient. So, and by the way, that's complicated for most people to understand. Here's something that's not complicated for people to understand. As far as I can tell, Silicon Valley Bank had precisely 1 individual who was a banker on their board, Mr. Thomas King. The risk committee of this bank, which tripled in size in 2 years, had no one. The risk committee had no one on the committee with any significant banking experience. So, Mr. Barr, I'm going to put you in an uncomfortable position and say, clearly what we have here is a gap of time and a failure of action between the deficiency rating in July of 2022 and the meltdown in March. That's a long period of time. So I'm going to ask you for ideas, not necessarily good ideas. I understand that you're going to be uncomfortable to make recommendations, but clearly we need to tighten up the process by which good things happen after a finding of deficiency. So should that be left in your regulator's discretion, or should we act in such a way as to make actions mandatory subsequent to a deficiency rating?
It's a great question you raise, and one that I think is appropriate for reviewing both by you and by us. I think that we need to put in place risk mitigants and incentives that are much stronger, faster in the supervisory process. That's one of the things that we'll be looking at in the review. But I do think that in instances like this, where it is such a fundamental issue, we need to have risk mitigants in place that are ordered by the supervisors quickly.
So I'm just going to make this observation as I run out of time. As we all saw, one of the problems here and one of the new things here were the chat rooms and the speed by which deposits could be withdrawn. And billions of dollars went out the door because of these devices. So I'm not convinced that giving humans who operate in human time additional authority is going to do the trick here. I think we need to think about automatic mechanisms, and that may require statutory change, automatic mechanisms that when a finding of deficiency or other adverse observations have been made, kick in automatically, perhaps after some cure period. But this was a meltdown that happened at the speed of light, and humans with discretion is not going to solve it in the future.
Gentleman's time has expired. The gentleman from Texas, Mr. Williams, is now recognized for 5 minutes.
Thank you, Mr. Chairman. I'm going to repeat myself a little bit, what you've heard today, but when I talk to community banks in my district, and in full disclosure, I'm a car dealer, and I talk to them a lot and owe them a lot of money. One of their top worries right now is being left to foot the bill for the failures of Silicon Valley Bank and Signature Bank. Community banks, which most of us live by, should not be liable to pay for the rescue of larger banks that gambled and made a risky bet. So community banks are relied upon Main Street, America, to be a lifeline and provide crucial banking services to small businesses. So these smaller banks, which we all need to have, are some of the most trusted institutions in the financial industry. So Mr. Grunberg, you talked about it before, but could you elaborate if smaller community banks in Texas, where I'm from, will be left responsible for bailing out the failed banks in California and New York, which we don't even know where they are?
Thank you, Congressman. I'm keenly sensitive to the concern. Let me just say, under the law, the FDIC is required to impose a special assessment on the banking industry to recover any cost to the Deposit Insurance Fund from covering these uninsured deposits. And we have to do that by a notice and comment public rulemaking, which we're going to do in May. And just to be clear, the law gives the FDIC authority to consider the types of entities that benefit from any action taken or assistance provided, so that the FDIC does have discretion. And let me just say, without forecasting what our board is going to vote, we're going to be keenly sensitive to the impact on community banks.
Take a look at it, because we all know that what they'll do is pass the cost on to someone like me. The Federal Reserve was supposed to be the primary supervisor over Silicon Valley Bank, but from all we've seen and heard today, they failed to do their job, and it's been reported that Silicon Valley's bank risk practices were on the Federal Reserve's radar. We've talked about that for over a year. In 2022 alone, Fed supervisors issued 3 findings on SFB's ineffective board oversight, weakness in their risk management, and flaws with the bank's internal audit function. So it should raise major concerns that the Federal Reserve, who is tasked with regulating and overseeing banks, knew about Silicon Valley's risky practices far more than a year and failed to take any corrective action. Now, Mr. Barr, what actions, if any, did the Federal Reserve take, and you talked a little bit about this, after issuing those risk findings, and how did the Fed Reserve become so complacent on its supervisory role and miss these warning signs? And I think that's what people across America really want to know.
Thank you very much for the question. My understanding is that the supervisors identified the issues, they brought them to management's attention. The response clearly was not an effective response. Bank managers failed to manage the firm in an appropriate way. They didn't manage their interest rate risk and their liquidity risk well, even though it was pointed out by the regulators. And I do think it calls for a heightened need for more aggressive supervisory action to take care of these problems.
But you all missed it too.
I'm sorry?
You missed it too.
The supervisory staff were aware of the underlying issues. I think all of us were caught incredibly off guard by the massive bank run that occurred when it did on March 9th and 10th. The scale and speed of that, $42 billion going out the door Thursday afternoon. It was expected by the bank that $100 billion more would go out the next day. That's just an extraordinary scale and speed of a run that not anything I had ever seen before.
Okay, out of all the banking supervisors, I would expect the Federal Reserve, and most of us would, to be the most aware of the impacts increased with rate hikes would have on the value of securities for banks. However, the Fed has stress tests, which we talked about, which are conducted to determine how large domestic banks would perform under hypothetical unstable economic scenarios, currently does not test for the problems that caused Silicon Valley Bank to fail. SFB failed because of inflation, rapid increases in interest rates, and loss in value of government bonds. So even if SFB had been subject to testing, it would not have led to the changes that could have prevented their failure, because the Federal Reserve is asking the wrong questions and not running scenarios that ultimately led to SFB's downfall. So we'll correct, Mr. Barr, how can the American people trust the Federal Reserve if you are not testing for all scenarios? How was the Federal Reserve so far off? That is a question that everyone asks again.
I think that the Federal Reserve should use multiple scenarios. That's one of the reasons why I proposed that for this year's test. It includes a rising interest rate environment for the trading book. I think multiple scenarios makes a ton of sense and should be done.
You know, that saying, they can get it right 100 times. You got to get it right once. So you got one crack at it. So thank you very much.
Gentleman's time has expired. We now recognize the ranking member of the Digital Asset Subcommittee, Mr. Foster, Illinois, for 5 minutes.
Thank you. As you know, 12 years ago during Dodd-Frank, a number of us put a lot of effort into specifically authorizing U.S. bank regulators to put contingent capital requirements into the capital stack of large banks. These can sort of be thought of as a sort of privately funded insurance policies that large banks are forced to carry that pays out if a bank gets into trouble and automatically injects capital into a struggling but not yet failed bank. Now, for the last 12 years, U.S. bank regulators have completely ignored this authorization from Congress, which I have complained about in numerous hearings. But in the last 12 years, European bank regulators and others have used contingent capital successfully. And so now I believe that we have a lot to learn about two side-by-side bank failures. First, Silicon Valley Bank, a large bank by some measure, but with total assets less than 1% of U.S. GDP, and Credit Suisse with total assets greater than 100% of Swiss GDP, too big to fail by any metric. Now, when a couple of weekends back, the U.S. banking regulators tried to find someone to buy SVB, they failed. The result was potential systemic risk and emergency intervention that has, by regulators, that's risked abandonment of a lot of market discipline and market chaos. And the deposit insurance fund and eventually banks and their customers must take the hit. But when Swiss regulators tried to find a partner to buy out Credit Suisse, they succeeded. And at this point, it looks likely that the Swiss taxpayer and their DIF will be off the hook for this giant bank's failure. And the difference was contingent capital. Because when Credit Suisse got into serious trouble, their contingent capital triggered and injected $17 billion of equity into Credit Suisse. This was absolutely essential to finding a buyer for Credit Suisse, since, as you know, Credit Suisse was bought for about $3 billion, but only after the $17 billion of capital injection by their contingent capital instruments. So the Swiss contingent capital succeeded at its two design objectives. First, to prevent contagion, and secondly, to keep the Swiss taxpayer off the hook for the failure of a truly giant bank. Now, if Silicon Valley Bank had been forced to carry an appropriate amount of contingent capital, then capital would have been automatically injected sometime probably Friday at the latest. And it was very likely that a buyer could have been found over the weekend as well. And we would not be having this hearing today. In fact, it's possible that they would not have gotten in trouble in the first place, since Silicon Valley Bank would have had to answer not only to the regulators, but to the bond markets for their risky practices. When they went through their gigantic growth spurt, they would have had to issue a lot of contingent capital instruments. And I'm pretty confident that one of the wizards in the bond market would have said, this is interesting. This bank has very flighty deposits and essentially no risk management in place. Maybe we should charge a pretty big risk premium, and the markets might have detected that. So my question is this: Vice Chair Barr, as part of your holistic review of bank capital requirements, will you commit to finally seriously considering contingent capital requirements in the capital stacks of large banks?
Thank you very much for your question, and I very much appreciated our conversations over the years on this very question of contingent capital instruments. Both the FDIC and we have issued an advance notice of proposed rulemaking of a different type of contingent instrument, a gone concern capital instrument that would be required for large banks. But I think it does make sense to consider alternative options, and I'd be happy to continue the conversations with you about that.
Okay, and I would specifically appreciate it if your analysis included a counterfactual analysis of how much better off we would have been if regulators had listened to Congress and included contingent capital requirements into the capital stacks of these banks. Because I think there's a lot to be learned from just the counterfactual analysis. I'd like to just close out by finishing up a little bit with questions about the non-responsiveness of SVB management to the early warnings they got. Is there leverage that we can provide you? An obvious one is to say all of these matters requiring immediate attention and so on are private. And what, for example, if they had to become public after 60 days if they were not resolved. Would that have lit a fire under the chair of the management? Are there other things? For example, you could say any management that had an ongoing a pending MR, matters requiring immediate attention, we would simply put all the bonuses in escrow. That would, I'm almost certainly get their attention. So are there, if you could
Gentleman's
include
time's
these sort of
expired.
ideas, I'd appreciate it.
If you'd submit for the record, Mr. Grunberg, Mr. Barr. Now recognize Mr. Emmer of Minnesota for 5 minutes.
Thank you, Chairman McHenry. Thanks for holding this important hearing today. The collapse of 3 regional banks over the course of 2 weeks is directly related to failed Democrat policies. Record inflation as a result of reckless government spending led to historic interest rates that banks were not ready to manage. It appears financial regulators were not appropriately communicating financial risks of the high-rate economy with banks in their supervisory capacity, and this administration's political attack, quite frankly, from the highest levels of our government on the digital asset industry, which, by the way, had nothing to do with causing the runs, sparked fear, leading to bank runs at Silvergate, Silicon Valley Bank, and apparently Signature, bringing these core issues plaguing our economy and the broader banking sector to the surface. Let's not be fooled. Providing financial services to legal businesses in the U.S. should not be risky. But this past month has proven that the mismanagement of our monetary policy has apparently made it risky to put dollars in a bank. Mr. Grunberg, will the FDIC sell off Signature's deposits from digital asset businesses? Yes or no?
We were returning those deposits to the depositors, Congressman.
So, okay. Does the FDIC plan to sell the intellectual property for Signet?
I believe that's already been sold out of the bridge institution, Congressman.
All right, we would like to see that information. Will you commit that a bank that buys Signet will be able to use it to facilitate 24/7 access to the banking system for digital asset companies?
I'm happy to look into that. I don't know who the buyer was, but be glad to look into it and follow up with you in regard.
You're not going to block the buyer from doing 24/7 banking for digital asset companies, is that correct?
If that's the nature of the acquisition, yes.
And will you commit that a bank that buys Signet, or the bank that did, will be able to onboard new digital asset customers?
Again, I'd like to look into the transaction, but I'd be glad to follow up with you in regard to it.
When the FDIC sold off Silicon Valley Bank's deposits to First Citizens, did that include deposits from any digital asset firms or VCs in the digital asset space?
I believe all of the deposits from the failed Silicon Valley Bank were transferred to First Citizens.
Including the digital?
All of them, yes.
Were all of SVB's deposits from digital asset businesses, again, transferred to Citizens? That's what you're saying?
My understanding, First Citizens assumed all the deposits of the failed.
Has the FDIC ever communicated implicitly or explicitly, sir, to any banks that their supervision will be more onerous in any way if they take on new or maintain existing digital asset clients?
No.
Thank you. The FDIC estimates that resolving Signature Bank is going to lead to a $2.5 billion loss to the Deposit Insurance Fund, and resolving Silicon Valley will lead to a $20 billion loss to the Deposit Insurance Fund. When the FDIC sold Signature, it had the effect of closing Signet, which is an innovative payment system that facilitated 24/7 access to banking services. Frankly, a private sector innovation that apparently will be rivaled by FedNow. Signet is intellectual property that has significant value, so I do want to see that sale. Chairman Grunberg, when managing the resolution of any failed bank, the FDIC is statutorily required to do so using the least costly resolution option, thereby minimizing losses to the Deposit Insurance Fund, which is replenished by the banks through fees that are indirectly passed on to everyday Americans with bank accounts. I'm concerned that the FDIC has deviated from its statutory requirement to minimize costs here, and has opted to pursue a lazy and destructive regulatory campaign to, in fact, oust digital asset opportunities from the United States. No bank is designed to survive manufactured bank runs. And in analyzing what caused this fiasco in the first place, many signs point right back to you and the FDIC, this administration, and certain reckless Democrat senators. I want to thank you again for coming today, and I appreciate a response to my March 15th letter, because to me, it's still clear that we have a lot of questions that need answers. And with that, Mr. Chair, I yield back.
Gentleman yields back. The ranking member of the National Security Subcommittee, Mrs. Beatty, is now recognized for 5 minutes.
Thank you, Mr. Chairman, and thank you, Ranking Chair. Mr. Grunberg, we know that both SVB and Signature had very high proportions of uninsured deposits, somewhere between 90-95%. Can you share with us or explain to us what the typical ratio is for your average bank and how this factor played into the bank run that we witnessed on March 9th?
Thank you, Congresswoman. It's an important question. I think fair to say these two institutions were outliers in terms of their exceptional concentration of uninsured deposits, both around 90%. In the regional bank space, between 100 and 500 or 600 billion, I think it's generally in the 40% category. So these two institutions were outliers, and it was a significant part of the liquidity risk on their balance sheets.
And would you say that this high proportion of uninsured deposits left the bank more susceptible to this run?
Yes, it was, I think.
Let me also have a follow-up question to you. We've heard many ideas proposed about modifying the $250,000. And we know in, I think it was 2008 with the Emergency Economic Stabilization Act, we went from 100,000 to 250,000. So for example, what about temporarily ensuring all deposits, increasing a limit to 500,000 or $1 million, ensuring all deposits for small and mid-sized firms, or limiting it for the largest financial institutions? What are your thoughts on some of these proposals?
Well, as you understand, Congresswoman, the coverage for deposit insurance is statutorily set at $250,000 per account. So to adjust it would require legislative change. And as I indicated earlier, the FDIC is undertaking a comprehensive review of our deposit insurance system, and we'll come back with a report that we'll release publicly outlining policy considerations for.
So is this one of them? And you can weigh in also, Mr. Barr or Ms. Lang, on, I mean, you're experts, you're testifying here on your opinion. I understand that it's statutory and requires it to come back here. And certainly, as you know, we've changed many things over the years in rooms like this. So to the public, I don't want you to think that this may be as far-fetched. We had large banks when we had too big to fail. And we're certainly more than $50 billion now as we had legislative ways to change it. So what are your thoughts on increasing? That's one of the number one things I'm getting from constituents. You know, it was just in 2008, it was 100,000. We made the change then through an emergency act. What now?
Congresswoman, I look forward, the FDIC, as Chairman Gruenberg mentioned, is doing a review of the deposit.
Would you
insurance
support
fund.
an increase?
I would support a study and proposals for reform if needed. The rise in uninsured deposits, it has been increasing over the years.
Okay, only because my time is running out. Mr. Barr, and the next question is going to be for you, so.
We'd be happy to work with you on thinking through that. I think taking a step back, the important thing is that our banking system is sound and resilient. The actions the regulators took demonstrate that deposits are safe, and we'd love to continue the conversation.
Okay, I'm glad you said sound and resilient. In your opening testimony, you said the same thing, that you thought banking was sound. You also used words like strengthening the public confidence, or paraphrasing it. I'm from Ohio, and the public pension fund nationwide, as you know, lost millions of dollars that were invested in SVB and Signature. In my home state of Ohio, the state teachers' retirement system took the biggest hit with some $27 million that was invested in SVB. Representing, I know, maybe only 3 or 4% of the fund's total portfolio, but I'm concerned about reports that the CEO of SVB unloaded millions of stock in the days and weeks leading to the collapse. I know that we're expecting a report on the Fed's investigation of SVB in May, but is there anything you can share today regarding the bank's executive management? And, okay, thank you, and thank you, Mr. Chairman.
If the panel would respond in writing to Mrs. Beatty. We'll now recognize the gentleman from Oklahoma, Mr. Lucas, for 5 minutes.
Thank you, Mr. Chairman, for holding this important hearing. And Chairman Grunberg, I'd like to discuss, and I know my colleague, Congressman Williams, Chairman of the Small Business Committee, has focused on this before, but I'd like to discuss the special assessment fee that will be used to cover the losses from the uninsured deposits. You've explained the proposed rulemaking for the special assessment will occur in May of this year. And while you're thinking about that, be thinking about a discussion of the flexibility the FDIC has during the rulemaking to ensure that our small community banks don't disproportionately carry the burden. Being one of the older members of this committee, I've been around long enough to have observed firsthand several banking crises. 1982, I was getting ready for my final semester at Oklahoma State when a little institution in Oklahoma City called Penn Square went down and took First Continental Illinois of Chicago down with it, a bank from the, 1840s or 50s. Took First Seattle down with them too. Now, FDIC and the regulators responded in the appropriate fashion and addressed that. But it was a combination of collapse in the oil and gas industry and in production agriculture. And the chain reaction in my great state was the slaughter of community banks. The slaughter. There was no quarter given to those folks. They were locked up, chopped up, sold out. The legislature met in the middle of the night to authorize not just one town, one physical location, one charter banking, but we went to branch banking because it was all falling down on us. The people who I represent were brand new young banking men and women 40 years ago when they saw how community banks were handled in my state. They weren't Penn Square, they weren't First Continental, they weren't Seafirst. They're now my most senior bankers 40 years later. And they're looking at this situation and they're saying to me, we've been the least problematic of any sector in the financial services industry for decades to the regulators and the FDIC. But yet, in every crisis since then, we've been kind of the orphans. And this time they're saying, we were wiped out as an industry 40 years ago, but now we're going to get a special assessment to pay to fund for the mistakes of the most sophisticated institutions, the biggest institutions. Can you tell me how it's possible when this special assessment fee process is completed that my community bankers aren't going to wind up disproportionately paying for the mistakes and the folderol of the biggest institutions in the country? Or are they just be prepared to be the goat one more time?
Critically important question, Congressman, keenly sensitive to it. We have discretion under the law. We have to act pursuant to a notice and comment rulemaking. Anything we put out will be subject to public comment, but we have discretion, as I indicated earlier, and will repeat, we'll be keenly sensitive to the impact on community. I don't want to front run my board. We're going to have to do a notice and comment rulemaking, but I hear you and keenly sensitive to the point you raised.
I would just offer once again the observation
the perspective of my community bankers is, if you're big enough, we've now given you an emphatic protection. It appears with what we've done in the last few months, if you're in that intermediate range, we're going to protect you. But if you're the little bankers, the little guys and ladies out there meeting the day-to-day capital needs, you're going to be the one to pick up the bill. And I kind of appreciate their point, having lived through 40 years of these experiences in my great state. Shifting to another question. As has been discussed today, Treasury approved the systematic risk designation on March 12th upon the recommendation of the Federal Reserve and FDIC. I want to discuss for a little bit the process leading up to this. I think it's important that we have a clear picture of how the regulators made this designation, and not just in theory, but in practice. So, Vice Chair Barr, could you provide insight into which regulator acted first in proposing that uninsured deposits be protected? These are the kind of questions I'm getting back home. And while you're thinking about that, were there discussions between the FDIC and Fed prior to the respective board meetings?
I see my time has expired, but I'm happy to follow up with you.
You can go ahead and answer it.
I bet somebody
I'm
will
really
give you
heightened
time.
right now and interested. Plus, we're close to getting a little break here, so.
I'm happy to. So
Please, thank you.
we were in conversations, all three agencies over the course of that weekend, trying to think through what the potential ramifications might be in the financial system. It was a very difficult judgment to make. It involves, of course, information we're getting from around the system, from hearing from community bankers.
If the gentleman will give a timeline of those conversations between the two agencies and the two principals of the FDIC and the Fed for a written statement. Gentleman's time has expired. We'll now go to Mr. Vargas of California for 5 minutes.
Thank you very much, Mr. Chairman, the ranking member. I guess I'm looking at this a little bit differently. And that is, we could have been here today looking at the collapse of hundreds of banks. We could have been here today trying to figure out how to stop the contagion. But instead, we're here looking at significant banks with significant problems. I think that that's important. But I think what's more important is that everyone worked together. We certainly have our ideological differences, and they're significant. I mean, I heard right away it was Biden's fault, from some members, and I could easily say it was, hell no, it was Trump's fault. But the truth of the matter is that, we're out of our ideological silos and trying to figure out practical solutions. I want to thank the chair. I think the chair worked very, very hard on this, and I think that he probably was a little uncomfortable with his ideologues on his side, maybe, but I think he did a fabulous job, and I want to thank him publicly. I think the ranking member did the same. I think they worked very, very closely together to try to figure out, what can we do as a legislature to make sure that there's not contagion. I want to thank all of you. I think all of you acted very honorably, nobly as you should have, to try to figure out what's the solution here. And again, I appreciate that deeply. Again, we could be here talking about a disaster, an unmitigated disaster. I was worried about that. I mean, I worry about these things, and we're not. Instead, we're looking at these important issues. So now that we are, and I got that off my chest, I do want to ask you, Mr. Barr, you were quoted quite extensively for saying, let me get it correctly here, I don't want to put words in your mouth. To begin, SVB's failure is a textbook case of mismanagement. Was that a correct quote?
Yes.
Well, then why, the natural question is, to begin, why wasn't there a textbook case of enforcement?
I think that's a good question, one we're exploring very much. The supervisors looking at the bank identified the problems with the bank. And the question is, did they identify them with enough level of urgency? Did they escalate appropriately? And I think that's what is an incredibly fair question we're looking at carefully. I expect that we're going to find that we need to have more of an emphasis on supervisors using the tools they have more promptly and putting in mitigants in place more promptly when they see problems at banks that they're supervising.
Yeah, in fact, they had a number of MRAs, MRIAs, I guess. And it didn't seem like you did anything other than write a letter. I mean, it didn't seem like there was any enforcement. I mean, where was the stick?
Yes, I think that's exactly the right question. Normally, in the supervisory process, when a supervisor issues an MRA or an MRIA, the bank promptly takes care of those matters. In this case, obviously, it didn't take care of them in such a way that it prevented its
It
sudden
seems like they
failure in
blew you
March.
off. I mean, it seems like they blew you guys off and you didn't do anything. I mean, that's what it seems like for reading all this information. I can tell you, maybe I'm wrong, but that's what it sounds like.
Yeah, I think that, again, we're looking at the whole supervisory record. I share your concern very much. I think it's something we're going to have to explore, both in terms of the way the bank responded and the bank's responsibility for its failure, but also should regulators have used tools to escalate more promptly and quickly? I think that's a completely fair question.
Okay. Chairman Bloomberg, in your hearing before the Senate Banking Committee, you testified that the collapse of SVB and Signature Bank demonstrate the implications that banks with assets over $100 billion can have financial stability issues. I think that's what you were quoted. Additionally, you stated that the prudential regulation of these institutions merits serious attention, particularly for capital liquidity and interest rates hike. Can you please elaborate more about what prudential regulations need to be reviewed? What steps can we take to mitigate the potential for similar bank failure?
Thank you, Congressman. Look, I think we should start with supervision and how we supervise liquidity risk. And two big things in this episode was liquidity risk from concentration of uninsured deposits and the accumulation of unrealized losses on the balance sheets of our institutions, both of which go to fundamental management of interest rate risk, which is
Right, but the size, I'm talking about the size of the
Yeah.
bank. I think
No,
that's significant.
and I think it applies to all institutions. I think in the past, we've looked at these regional banks and smaller regional banks, and in terms of their prudential regulation, have treated them somewhat more lightly than the larger institutions.
My
I
time
think
is
in light of this episode, we need to take a close look at that.
Thank you. I
That
yield
was the
back.
point I was trying to make.
Well, with the windup that Mr. Vargas gave, I just want to give him like 10 more minutes. So thank you. With that, we'll now recognize Mr. Loudermilk of Georgia for 5 minutes.
Well, thank you, Mr. Chairman. Thank you all for being here. I know you've been spending a good bit of time on Capitol Hill, but we appreciate you being here. One of the concerns that I've received from a lot of my smaller institutions, smaller banks, is with the extension of insuring deposits across the board, they felt vulnerable in that larger institutions may decide to pull deposits that they have in the smaller institutions because then they would be covered. Under Secretary Lang, I wanted to get a little clarity on what seems like is conflicting accounts from Secretary Yellen regarding deposit insurance. Now, on Tuesday, March 21st, the Secretary suggested deposits would be insured. She said, quote, if smaller institutions suffer deposit runs that pose the risk of contagion, then that was the end quote, then during her testimony to the Senate Finance Committee the very next day, the Secretary said she was not considering, quote, blanket insurance or guarantees of deposits. But then a day later, she said that Treasury, quote, would be prepared to take additional actions to protect depositors if warranted. Could you clarify the Department of Treasury's position regarding deposit insurance?
Yes, thank you, Congressman. As Secretary Yellen has said, we have used tools to prevent contagion in the banking system and have reflected a commitment to ensure that all deposits are safe. And that means we would use the tools again, if needed, to ensure that Americans' deposits are safe.
So your answer is yes, you would include smaller institutions, smaller banks, community banks, or, I mean, I'm a little confused.
If conditions warranted, deposits that smaller institutions could pose a risk of contagion to the broader system, we would absolutely use the tools.
So I guess the question would be then, what is that condition? If it starts with one community bank, then that would be a trigger, or Do you have more definition of what would be the condition?
I think it's very difficult to just make decisions on the hypothetical, but in this environment that we made the systemic risk determinations based on unanimous approvals from the FDIC and the Fed, we determined that the risk of contagion in the banking system was very high.
So with that and the action of extending it to larger institutions, regional banks, and then smaller institutions, do you have concerns that regulators may be creating moral hazard across the entire banking system?
I think we are concerned with addressing the current situation that we are facing. We think the system has stabilized. We have information and evidence that deposits have stabilized. We will need to address reforms going forward to address concerns about moral hazard.
Okay. And I agree with you. I think that we're stable at this point, but as we've seen already, things can turn around in a 24-hour period, right? And I am one of those that, from raising 3 young children and now with 5 grandchildren, consequences matter in future behavior, and we can't ignore that going forward. Last question. Why did the Secretary's position appear to change regarding the extending insurance to various or to smaller institutions? Why did she change her position between the 21st and 23rd? Were there internal discussions going on between the Secretary and the President or other prudential regulators that caused the shift?
I'm not aware of any conversations.
Okay. Well, I appreciate that, Mr. Chair. No further questions at this time, and I yield back.
Mr. Casson of Illinois is recognized for 5 minutes. And after this end of the series, let me restate this. After these 5 minutes, we'll give the panel a little 5-minute break, stretch your legs, then we'll come back in and we'll finish with questioning. My expectation is that then we'll be able to get through this final segment. But I do think it's humane to actually give a panel this bit of break, and frankly, I need one as well. So, Mr. Caston, 5 minutes.
I'd like to thank the chairman for putting me on the inhumane end of that transaction. Vice Chair Barr, I'm trying to understand the calendar, and I've got just 4 or 5 questions for you, and I want to walk through the calendar as I understand it. If you disagree with anything I've got in the calendar, let me know. But otherwise, I'll just try to run through quickly to get to the questions. January 2019, SVB is notified by the Fed of deficient risk management. A year later, they're notified that their risk management is not up to large bank standards. About 2 years after that, April 22 to 23, SVB no longer has a risk officer, but in their 2023 proxy statements, they say that they have doubled the number of risk meetings from 9 to 18. Given the prior concerns from the Fed, did the Fed participate in or otherwise have visibility into any of those risk meetings at SVB in that window?
The calendar you described, the dates didn't, they are some of them in the future. I think that we might need to look at the calendar reconciliation together, or maybe I misheard.
No, I'm just going up to January of this year was the last date. From April of 22 to January of 23, there was no risk officer, but a doubled frequency. Did the Fed participate in any of those risk meetings within SVB during that 9-month period?
I don't have yet the full supervisory record, so I'm not able to answer the question, but we will have that information in the May 1st.
Okay. Do you know if they were at any time cited for violating Section 165 of Dodd-Frank that requires banks over $50 billion to have a risk officer for the 9-month period when they did not?
The deficiency downgrade that occurred in the summer of 2022 focused on a wide range of risk management practices at the firm and found them to be deficient.
Okay. Moving back to the calendar, Q3 of 2022, their 10Q showed that their held to security bonds were $15.9 billion undervalued relative to mark to market, and they had $15.8 billion in equity at the time. 3 months later, their 10K for the year showed a slight improvement. They only had a $15.1 billion overvaluation of their bonds and $16.3 billion in equity. Was it perceived by the Fed or by management that they were in an improved risk situation at the end of 2023 than they were 3 months earlier?
I don't know the answer to the question with respect to how the management of the firm were viewing the situation. The supervisors were telling the firm at that time that basically their risk models were divorced from reality, that the models suggested they'd earn more money when they were losing more money.
Okay, I'm glad to hear that, because now I want to move to 2023 and sort of what happened up to March 8th. January 26, 2023, about 3 weeks after they finally got a risk officer back, CEO Becker announced that he was going to execute 3.6 million in stock sales. February 22nd, he executed those sales. March 8th of 2023, he announced a sale of all of their available to sell equity portfolio to Goldman. The same day was disclosed the $1.8 billion loss of a security sale, apparently also to Goldman. Heads Goldman wins, tails Goldman wins. And of course, the next day, a $42 billion withdrawal. Do you have any visibility? When was the security sale and or the equity sale to Goldman process initiated? In other words, when was it announced? When internally was the company initiating the process to secure additional cash from those two Goldman processes?
I do not know the answer to that question.
I imagine you probably also don't know whether the January 26th sale was cleared with their risk officer, who had been on board for 3 weeks when the January 26th announcement was.
I don't yet have full visibility into that transaction. I hope that we'll be able to get as much detail as we can as part of our review.
Okay. Do you know, if I'm Becker, I'm obviously in a lot of trouble. You've got a deposit base that is extremely well-heeled and very sophisticated. Was there any outreach to the depositors during this period to ask them either to provide equity infusions to the bank or other forms of capital prior to the run of the bank?
I do not know.
Last question. In the exchange with Mr. Scott, you had indicated that and I think I got this right, that the Board of Governors' concerns about SVB were really heightened in mid-February.
What I said is that the staff presented to the Federal Reserve Board of Governors in mid-February on interest rate risk generally, and one of the firms they highlighted as having interest rate risk was Silicon Valley Bank. And the staff indicated that they were doing a further horizontal review and would come back with further results of that review.
Okay, so is it your position that the trigger for the heightened security was simply interest rate movement, or was it anything else about this calendar that triggered that heightened concern?
I didn't describe it as heightened concern. Basically, the staff were presenting on interest rate broadly, and the firm they singled out as having interest rate risk was Silicon Valley Bank, and they discussed the horizontal review they were doing and the fact they'd come back with further information after that horizontal review.
Okay, thank you. I yield back.
Is he supervision? Okay. We'll now stand in recess. Committee stands in recess for 5 minutes.
Okay, team. So I'm going to go ahead and close it down here. I had no idea it would last this long. We do have GDP data tomorrow. We have PCE data Friday. We've got jobless claims tomorrow. We will be back. If you want to watch the full video, you can find the link in the description if you reset it. I also post the link right here in chat. So that's the full link to the hearing. If you click on that link, it will bring you. All right, let me make sure that's the right link. Hold on. That might be the wrong one. Here, I'm going to delete this. Let me make sure. Hold on one second. Let me go to the link. Yeah, so I believe that's the right link. Let me make sure. Yeah, so that's the right link. Okay, so the link is in the description. We also posted the link here. I understand it's not over yet. If you want to watch the full thing, I posted the link to the actual Fed's website. You could watch it. I have to close this down because I have to leave the house. But we will be back streaming the full GDP jobless claims data tomorrow. It drops at 8:30 in the morning. We will start the stream early. Be ready for that. We'll see you guys later. You can find the link to this in the description. Also, guys, like I said, check out Chart Prime. I've been looking at Chart Prime all day. Chart Prime can be super powerful here. Like I've been using it in trading, using it. I'm up today. So you can see I'm actually green on the day. I can go over my results real quick, just so you can see. But I am green on the day, and I have been using Chart Prime a lot with my trading. You see, I'm up about 200 on the day. Chart Prime has alerted a bunch of different signals that ended up working out. If you look at Chart Prime here, it's a trading view indicator service, so you can use it on stocks, crypto, forex, futures. They're not always right, but I've used them since the opening bell. And look at this. It literally called like every one of these bounces and these drops. You can see it gives you reversal signals, and their oscillator's really solid too. So you can see the oscillator and the reversal signal. You get a nice bounce there, possible reversal up here, nice bounce there, possible reversal up here. You get a nice bounce. This one, it called the exact drop afterwards as well. And you can use this on any time frame. So like, look, it dropped over the next 3 minutes. So if you want to use it for day trading, you can. If you want to spread it out and use it on an hourly basis, you can. Very, very useful. Can be very, very powerful here as well. Look at these reversal signals, literally right at the very bottom of this. So like, look, and this is hour-long candles here. So possible reversal up over literal days of price action. Possible reversal up literally right at the bottom on an hourly chart. You can use it on a daily chart for longer-term trading as well. Again, it gives you reversal signals. It shows you indicators, candlestick patterns, and it's $35 a month. Again, you can use it on stocks, crypto, forex, futures. It's called Chart Prime. I'll put this link up. And again, guys, tomorrow, the big thing, about tomorrow, guys, is GDP data. So GDP data comes out tomorrow. It is incredibly important data. Very, very important data. Again, the expectations for GDP, if we look at what we're expecting tomorrow, the expectations for GDP are for, I believe it's 2.7%. Yeah, 2.7% quarter over quarter for GDP data. It's one of those situations where we don't know if a good result or a higher result is going to be interpreted as positive, because some people are going to say, hey, well, if GDP growth is there, inflation's really bad. I think right now, more GDP growth will probably be better because of the banking problems going on, but it's certainly not a for sure thing. I could be wildly wrong here. It could be something where lower GDP is worse and higher is better, because that means economical growth, which is good for recession fears. Or it could also be something, if GDP is high, the market reacts negatively to it because of inflation fears. Let me know which one you guys think. Good luck. I'll see you guys tomorrow. And yeah, tomorrow will be very, very interesting. Good luck. Love you all. Y'all be safe.